concerns. We, sort of think about it as pure monetary policy.
It's interesting when we say, to what extent are bonds a hedge? Are they suddenly doing what they were supposed to do in terms of grave risk? In actual fact, if you look at gold, if you look at Swiss, they have outperformed up until now, up until close of business yesterday. I'll get a load of IBs. They were the much more defensive kind of hedge, and we were slapped when we said that treasuries were a hedge. So it was Swiss and gold. That maybe that's pivoted, maybe that's changed.
Coming up, Fadi Birol of the IEA talking about the oil complex.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Another day, what will the market bring? And when I say the market, I'm talking about the bond market because that's all that seems to matter these days. John Farrow and Tom Keene are off today. I am very lucky to be joined by Menace Cranny and Gina Martin-Adams alongside me as we take a look at a market trying to bounce on the heels of maybe a little bit of a bond rally yesterday, but not today. And this, as the session grows older, just shows volatility is just the name of the game when it comes to the bond market. 10-year yields up just a touch, 4.85%, basically stagnant relative to where we have seen S&P futures up 0.4%. Menace, how many of the guests this morning we're really just trying to understand why we have seen such incredible volatility.
I think you can throw any reason at this. You know, it's interesting, Jamie Dimon, the last clip that we played from Jamie Dimon was, does it matter if we get another rate hike? No, absolutely not bothered. But you could be prepared for another 100 basis points of steepener, which is not what happened in the market yesterday. There was a sense of exhaustion of the steepeners yesterday. There was a sense of exhaustion having tried to punch it up, and it just became a little bit exhausted.
Yeah, exhausting is the name of the game, and a lot of stock pickers are trying to figure out when they can start caring about earnings. And again, General Motors just coming out with third quarter adjusted earnings per share at $2.28 versus the estimate of $1.84. When can we care about earnings again, Gina? And that's really a key question.
I think it all comes down to the bond market, frankly. We've got to have some stability in the bond market before the equity market can calm down. I mean, this has been a really interesting earnings season because we've had about 75% of companies beat expectations. That's above the long-term average beat rate. You're still beating the long-term forecast. Analysts generally are still a little too pessimistic, so that tends to be an environment that's pretty supportive of equities. And yet price reactions, even for beats, have been way below average. There's just no upside off of earnings emerging yet. And I think that's because of the bond market.
We're going to be catching up with Paul Jacobson of GM later this morning in about an hour, a little bit more than that, to try to parse through the positives of the earnings plus what we've seen in the striking situation as well as with labor negotiations. Under surveillance this morning over in the Middle East, Hamas releasing 2 more hostages. Calls growing for Israel to rethink the scope of a ground invasion of Gaza. French President Emmanuel Macron is the latest world leader to visit Israel. He's meeting with Prime Minister Benjamin Netanyahu, where he's expected to call for the resumption of a peace process between Israel and the Palestinians. It is hard to get your hands around some of the negotiations behind the scenes, but Manus, to me what stood out was just that the ground operation seems to be delayed for a longer period of time, and it's due to pressure internationally.
Yeah, and that pressure is mounting. Macron is just, you know, the Greeks were coming, the Dutch were coming, the French are there today. Now, will he build the narrative for ceasefire? And this was one of the, if I can use the word criticism, it was one of the aspects which came from the gathering of the Arab nations in Egypt over the weekend, that the coalition of the West had not been calling strongly or loudly enough for a cessation and a ceasefire. So let's see what the Macron narrative is today on the ground.
And Jennifer Flitton definitely highlighting all of us, and as we watch everything that transpires overnight, every single morning and afternoon. Meanwhile, fresh data suggesting that the European region may be in recession ahead of the ECB's rate decision on Thursday. Composite PMIs coming in at a 3-year low, comfortably under that 50 mark that separates expansion and contraction. Meanwhile, Barclays planning to cut costs after its trading division missed estimates in the third quarter. The UK bank reporting fixed income, currency, and commodity trading declining 26% from a year ago. Banks are at one side, especially after the U.S. Banks really showed that beat. But Gina, what you're seeing in Europe is not unexpected, right?
No, it's not terribly unexpected, and especially with respect to the PMIs. Europe has been the weak player on the global stage now for several consecutive months. This really started to emerge this summer. I think in the banks, it's very interesting within the European banks. All the banks that had reported prior to Barclays had beat expectations. So when there's a divergence occurring between the continental European banks and the banks in the UK, the banks in the UK experiencing something very similar to the banks in the US, which is all about deposit flight, movement into money market accounts. The European banks have this sort of inherent stability, better net income, net interest margins as a result of that lack of flight into money markets happening in continental Europe. And so that's a source of stability amidst all of the PMI weakness. At least the banking sector does seem to be somewhat resilient.
Well, I'm not exactly down on my own, either in Ireland or in the UK, but the level of sophistication that you have, or the access to movement of money very quickly, very easily. You walk down any high street, you don't have high streets, any avenue in New York, and you're able to immediately pull up an app and transfer the money into any house for, you know, an ETF. It's much easier here and much more part of the zeitgeist to move your money around. Barclays underperformed, and they underperformed not just to estimates, but they underperformed relative to the US. There's only one sort of vainglorious banker in Europe at the moment. Guess who that is? Andre Orchal. I mean, he must just be sitting back going, that was a good move.
I'm sure he will.
I left Sergio on the Hollywood team behind.
Well, maybe he'll go shopping, because it seems like that's what a lot of people are doing. Hermes sales jumping as shoppers in the U.S. and Europe splurged on the company's pricey Birkin bags. The luxury French brand saw third quarter revenue rise around 16%, beating analyst estimates, and this comes after LVMH disappointed. How does this challenge the narrative, Gina, that we are seeing a pullback by spenders at the top end, which was basically what everyone was saying with LVMH.
Yeah, so one key difference, I was speaking with my European equity strategist, Laurent Douillet, this morning about this, about the difference between LVMH and Hermes, and why is Hermes so much more stable? And he said, well, remember, LVMH has a wine and spirits business, and that was actually the source of weakness in the quarter. We sort of forget the diversity of these organizations, whereas Hermes pure luxury, clearly best in class, still doing generally fine. Some disappointments, but generally fine. LVMH had that drag from wine and spirits. So I think the story's a bit deeper than sort of just, oh, luxury, are they or aren't they? I think it's actually about product mix and the mix of within the companies themselves, sort of some key differences. But Hermes still clearly the leader.
All I can say is I'm personally deferential to Prosecco over champagne. I'm just saying, so I understand why that might have been a drag. This is really going to be one of the most important conversations of the day, and it really comes as everyone looks at the crude price to understand the geopolitics and what the risks are that are percolating on any given day. The International Energy Agency was created 50 years ago in the wake of price spikes and all sorts of geopolitical violence. Today, we're facing a similar type of moment. Joining us right now, Fadi Birol, Executive Director of the IEA. And Fadi, I want to start there. Even as you put out your report, which has a lot of really interesting projections, how is today similar to 1974?
Thank you. I mean, the main similarity is once again a major geopolitical crisis in Middle East, and once again oil markets risk to provide a major shock with a high and volatile oil prices. Oil security is at risk, as about 1/3 of the global oil exports come from that region, especially for Asia. So there are some similarities between now and 50 years ago.
Fatih, good morning. Every time that there is a moment of real angst, and we are at the moment of war here, so it's not just angst, it's war between Hamas and Israel. The question is the boundaries, the risk to Iranian crude moving, the risk to the rest of the Persian Gulf from this Israel-Gaza crisis. How do you look at that right now, and what is the risk of major escalation in your view, and the risk to the oil market?
So if one or more major oil producing or exporting countries are involved in this crisis, we have all the reasons to expect that the prices will go up, not only in terms of production, export, supply cuts, but there is a major strait, the Strait of Hormuz, which is responsible about 1/3 of the global oil transit and a major part of the global LNG, natural gas transit. We may well see substantial impacts on the oil and natural gas markets. Of course, we don't know, at least I don't know, how the geopolitical developments will go in the next days or the weeks to come, but the risk is rather high for the energy markets.
One of the narratives that is out there at the moment is that obviously you still have unilateral cuts from Saudi Arabia and from Russia. Novak has made it clear it's too soon to talk about what they would do in November. If there is a significant escalation, is that step one of an immediate release valve to the market of where Saudi and Russia may well put out some narrative in regards to their unilateral cuts, or indeed act before the November meeting?
Yeah, it's a good point. In fact, when we look at the situation today, even before the crisis, this geopolitical crisis started, we had oil prices around $90. Very, very high prices compared to averages. Why we have it? For two reasons. One, global oil demand is strong, mainly as a result of the rebound in the Chinese economy after the COVID. But second, the point you mentioned, Saudi Arabia and Russia deliberately cut their oil production. And since beginning of this year, the International Energy Agency, we said, if you go in that direction, we may well see tightened oil markets, which could be a major problem for the global economy. and for inflation, especially for emerging and developing countries. Now, this crisis come on top of the $90 oil prices. And the one, of course, plausible scenario here, if we see such a crisis, and if we see a deepening of this crisis as a result of some other countries being part of this geopolitical crisis there, then one possible option is the Saudi Arabia and Russia would change their production policies, and they have ample amount of spare production capacity.
Okay.
They comfort the markets there.
Can we zoom out a little bit and talk about your long-term views on what's going to happen in the energy complex? I mean, we've got this great World Energy Outlook report out today from your organization talking about, in the long term, global fossil fuel demand will peak by 2030 as we see the transition occur. Does that presume that the geopolitical tensions ease? What are the presumptions behind that peak forecast by 2030?
Now, we are an energy organization. We cannot focus what happened on geopolitical context, but the reason that we see, for example, oil, we talk about oil demand to peak in the next 5 or 6 years is the following. There is a big move on the transportation sector, which is a big chunk of the global oil consumption. Electric cars. This is when you look at the electric cars. 2 years ago, 1 out of 25 cars sold in the world was electric. 1 out of 25 2 years ago. This year, 1 out of 5 cars sold is electric. And in 2030, with the current investment plans, current policies, every second car sold will be an electric car in 2030. This is one. On the consumption side, it will be weaker. The second and most important one, and I'm a bit surprised that the analysts don't see this, China. China changed the energy markets in the last 10 years, and China is changing itself now. When you look at the last 10 years, more than 2/3 of the global oil demand growth came from China only, more than 2/3. And Chinese economy increased over 6% per year on average, and this was the main driver. And we all know, it's a consensus view, including the Chinese government, Chinese economy will slow down, and this will be another driver for the global oil demand peak in the next years to come.
Fatih, I only have a minute left, but this is a really important point. Are you saying that even if China has an economic boom, it is not going to increase some of the demand for oil based on the changes in that economy?
I mean, China may have a growth in their economy as a result of stimulus a year or so, but the structure, Chinese economy, when you look at the structural, the balances in the Chinese economy, the cement production, the iron steel production, the household stocks, they all come to a saturation or a decline. China wouldn't need major amount of energy, so China will be determining the next years the fate of fossil fuels, and also at the same time, of course, clean energy, as they are a champion there as well.
Fatih Birol of the International Energy Agency, thank you so much for taking the time at a pivotal moment. We're all watching the price of oil to get a gauge on just how potentially wide the conflict could spread in the Middle East. Coming up, Jennifer Johnson, President and CEO of Franklin Templeton. We also will be speaking with the former Prime Minister of Jordan. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Long term, I'm certainly optimistic, but I'm uncertain right now. And if you're a CEO and you're uncertain, you tend to be cautious about doing significant things that change the trajectory of your business.
All of the CEOs in Davos of the desert. That was David Solomon, Goldman Sachs CEO at the Future Investment Initiative in Riyadh. Right now in markets, you can see yields just trying to hold on to a bit of a decline, but not succeeding. 10-year yields 4.85%. S&P futures holding on to gains up 0.5%, and euro softness after PMI data that showed potentially 2 straight quarters of recession or 2 straight quarters of contraction. Right now, I don't want to delay a great conversation coming up. Bloomberg's own Youssef Gamal Al-Din is joining us, sitting by with Jennifer Johnson, President and CEO of Franklin Templeton in Riyadh. Let's head over. Youssef, hey.
Hey, Lisa. Yeah, so let's pick up on the big debate on the health of the U.S. economy and a few other angles as well. Jenny, thank you for making the time. So we had Jamie Dimon come out strong. He's saying there should be a lot more humility from central banks. They got all their forecasts wrong. Ray Dalio is pessimistic. I want to know where Jenny Johnson stands in this debate.
Well, I mean, I am a little concerned about U.S. debt and its impact on interest rates, right? I mean, I think that the conversation on rates is constantly focused on what Powell's going to do next month or December. And I actually think the bigger story is really around, you know, we've got a U.S. debt that has gone from $9 trillion to $31 trillion. And you have to have buyers of that debt. And that means you have to have a rate that's reasonably priced to attract debt. And it potentially crowds out some of the other investment opportunities. So, you know, that's a concern. And you've got a deficit this year that's going to add $2 trillion to the debt. So I think that can weigh on the economy.
And where do you see interest rates going then? I mean, 2 weeks ago, you still had the view that there's one more hike in the plan. Do you still stand by that?
I think Powell kind of came out and said probably won't do it in November, but he's watching the data. So I think, you know, maybe he'll do December. I think it'll be data driven. Maybe he'll just kind of leave it for where it is and see how it plays out. I think the bigger story has been around the 10-year, and I think that's more of an issue around the, you know, U.S. debt.
I mean, you've seen the volatility in Treasury yields, and of course some of the, you know, prolific commentators, let me put it that way, including Mr. Ackman and many others. Do you think that we're going to start consolidating now at the current levels? I mean, what's going to bring them down? Because there was a big debate on what's going to carry them up. If they are going to go down from here, where, you know, what's going to push them down?
I mean, honestly, there's a lot of things, you know, I think that the Fed has done a good job on kind of jamming on the brakes and raising rates and slowing things. But, you know, there's tremendous headwinds to slowing inflation. Oil prices are inflationary. You know, some of the union wage negotiations are inflationary. So there's factors that makes it tough. You know, spending on things like renewable energy, government spending and incentives on renewable energy and things like the CHIPS Act are all pumping money into the system. That becomes a headwind to somebody who's trying to tamp down inflation.
One of the stories that's been trending in the last 24 hours on the terminal is about $600 billion worth of client cash, that it's headed for the exits from some of the bigger investment funds. And it raises the question, how does Franklin sort of thrive amid a shift to more passive solutions?
Well, first of all, let me take on that.
Are you going to push this back?
I'm going to push back on the passive active. All right.
Okay.
Anytime you have a full momentum market where you've literally had central banks printing money, right, and interest rates zero, the only place to go was the equity markets. That pumped the equity markets up. But today, right, and first of all, nobody ever talks about market beta or passive as going up or down in risk. The day Tesla was added to the S&P 500, market beta became more risky, right? And we don't talk about that. Now you're sitting here today. You've got a market where you look at it and say it's up 13%, but actually most of that's because of 7 stocks, the Magnificent Seven. You're seeing the highest concentration. You know, at the peak of the dot-com, 10 stocks accounted for 25% of the market cap. Today, that's 30%. So, or 32%, right? So you're even higher from a concentration. Usually doesn't end well after that. And from the return standpoint, top 5 stocks have a P/E ratio of 49. And the rest of the market has a P/E ratio of like 14. So, you know, those are really different from a risk scenario. Now you got to navigate interest rates. You got to figure out the impact of rates on different companies. I think it's a time for active management.
That warrants its own debate. I want to get to your meetings here in Saudi Arabia. Talk to me about the opportunity set here and where you could sort of lock in additional growth.
Yeah, so, you know, I'm here at FII, and, you know, one of the reasons to be here is because Franklin Templeton's a global company. We have clients in 160 countries. You come to FII, you can meet your clients from Asia, from the U.S., from Europe, from all Africa, all over the world. And so it's a great place to convene and efficiently meet with clients. But it's also, I mean, I tend to think energy transition, a lot of the innovation is coming out of this region. And I know that sort of sounds counterintuitive, but what you find is a mentality of multiple generations, thinking about how do we position ourselves for generations, and a recognition that at some point oil goes away, we better diversify the economy. And you see initiatives like in Saudi Arabia, where by 2030 they want 50% of their energy coming from renewables. UAE, I think, has said by 2050 they want 50%. Yeah. This is a region that has the will and the capital to actually focus on that innovation.
We're closely monitoring what's happening with the Israel-Gaza conflict. It's a human tragedy in the first instance. In terms of sort of second-round effects, capital markets, to what extent is that going to take away from some of the ambitions that the Gulf has as an investment destination, longer term?
Well, first of all, I mean, it's an absolute humanitarian crisis. It is a terrible, terrible situation. It's very difficult to watch it unfold, and it's awful. If it stays contained, it probably won't have longer-term impacts other than in obviously tremendous impacts in the areas in both Israel and Gaza. But as long as it remains, you know, contained, then I think it doesn't slow things down. And honestly, I think, you know, places like Saudi and the UAE are actually motivated to try to come up with a resolution because they don't want to derail the progress that they're making on their visions, you know, and trying to attract capital into the region.
So closing question on broader strategy. You've been acquisitive. What's sort of next on the purchase list? How much are you willing to allocate?
Well, we've been very open about the fact that we think sort of the last area that we'd love to fill is infrastructure. I think the spending on infrastructure, whether it's energy transition or even just updating infrastructure, you know, across the globe, because so many of the developed markets have aged infrastructure, is a great opportunity. So that would probably be the last area that we feel we need to complete sort of our product capabilities.
Jenny, great to touch base. Thank you very much. Best of luck with your meetings over the next couple of days. It's Jenny Johnson, the CEO of Franklin Templeton. Lisa.
Thank you so much, Yusuf. Great interview. And honestly, really interesting to hear her talk about how it really is the budget deficit, above all else, that is causing yields to whipsaw. Gina, you were saying earlier that, yeah, all of a sudden this is underscoring the idea that maybe this isn't a haven in the way that it has been in the past.
Yeah, and it's very confusing for the equity market, which is already in a confused state with respect to bonds. I mean, let's not forget the fact that correlations between stocks and bonds have completely flipped into bizarre territory over the last 3 years. The correlation is in completely alternative territory relative to where it was for the last 20. So we're more sensitive to movements in bond yields. The directionality of yields is important, but the volatility is also incredibly important for the equity market underpinnings. And to have this kind of uncertainty from a geopolitical perspective, as well as from a just general operational perspective from the U.S. government, creates a lot of uncertainty for the equity market that you wouldn't have normally considered this. But nonetheless, the two asset prices are very closely correlated, and our fates are tied.
the structure of this bond market, and this is the point that we touched on yesterday, has irrevocably changed. We're in an era of QT, no longer QE. We're in an era where banks are perhaps a little bit more judicious about what they want to do, how much they want to hold in the hold to maturity bucket. So the natural go-to buyers of this paper that needed to be printed for the fiscal needs is very, very different. And Jamie Dimon, just to punch it again, he said he doesn't care about the next hike, but what he does care about, and he referred to it, is the potential for more steepeners to come back and bite us, which goes back to his narrative, I know, from a couple of weeks ago.
But he's not wrong. I mean, when I talk to people, they say you can focus on whether you're going to get another 25 basis point rate hike, but if you're really looking for things to talk about, there probably is something better that you can spend your time doing. Gina Martin Adams of Bloomberg, unfortunately, we're running out of time. Do this again because we love having you on. So great to have your wisdom. Menace, you're not going anywhere, sorry. But coming up, we're going to be hearing from JP Morgan's Jamie Dimon himself. Maybe he will continue to be fiery, maybe give a prescription and maybe run for something, because that has always been the speculation. Joining Carlyle co-founder David Rubenstein. We also have some fabulous conversations, including the CFO of General Motors at a time of strikes and higher labor costs. From New York, this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can
Kind of
imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
This noise
is noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
you called the Bill of Bill. Excellent adventure, which I'll let you explain because I'm going to get all sorts of heat for saying this. But there's a question of whether Bill Ackman came out and said he was closing his short on long bonds, and then everyone went and bought. I personally don't buy that.
Please.
Do you buy that in any way, shape, or form?
Not at all. I mean,
Okay.
I think what he says, well, maybe I'm wrong. Maybe the whole market did listen to Bill Ackman and to Bill Gross. I think there was something of an extremely stretched steepener trade, which everybody's banged the drum on for the past number of sessions. The market wanted to test 5. It wanted to take it out, test it, punch it, go through it, and what you have is just a recalibration. That's my personal take on it. I've been in this pain trade for long enough, so.
How much of this is just being very oversold into resistance or overbought into resistance on yields, meaning that you move so far, so fast into that important psychological level that anytime you get to that overbought state, it's likely you're going to see digestion?
Well, at this point, though, there is this question about treasuries and their ability to act as a haven asset. I think that the underpinning some of the angst of the moment is the fact that we do have these geopolitical tensions, which are truly raising some serious concerns about the ability of the U.S. to respond. Is that what we've learned this week, that treasuries no longer are that haven?
They eventually will be that haven. I think some of the reason we've seen that upward movement is we've had a buyer's strike. The data hasn't been that bad, so people look around and say, how much safety do I need? But if they're starting to worry about the data, then that's when you start to see people step back in.
And that's where Bill Ackman said, look, there's too much risk in the world to remain short bonds. So for him, that was part of the thesis about why he wants to buy. But he went on to talk about growth. He said the economy is slowing faster than the data actually points to. And you pointed out the Atlanta Fed data yesterday at 5.4%. But the bottom line is, with so many geopolitical risks out there, with so many unknowns there, and potentially a slowdown, maybe this is part of the Ackman narrative, but I don't think we can attribute Bill Ackman and Bill Gross as having delivered such a virulent move in the longer end of the Treasury curve.
Probably wise. A bunch of people looking at earnings right now, Cameron.
It is very important because it gives us an indication about where that future path of growth is going to be. Manus, you had a really interesting interview this morning talking about signs of weakness within the beige book for the consumer.
Fact of the day from MUFG.
And so how much are we going to see that show up in the earnings that we have? That will show up in even some of those big tech names, which have been benefiting from this better consumer, this better cyclical environment. But what if that starts to slow down, mostly in 24, where estimates are forecasted to have 12% growth next year?
It is a confusing stew out there. And right now, equities are getting a little bit of a bid after yesterday's turmoil, which actually did not see equities get rewarded as much as yields plunged as much as 19 basis points on the 10-year. Today, you could see about a 0.5% gain on the S&P 4263. 10-year yields just marginally higher. But to me, this is interesting. The fact that they started the day lower after yesterday's plunge, now shifting higher. Wait till the end of the day. Who knows what's going to happen? It's been a wild ride. And crude up about 0.4%. What we're looking at today, after getting some negative reads on the U.S. economic, European economic output, we get U.S. S&P Global Composite PMI data at 9:45 a.m. Today, we also have the Future Investment Initiative Conference in Riyadh. We have been hearing from interviews all morning. We're going to be hearing in about 15 minutes from Jamie Dimon of JP Morgan in conversation with David Rubenstein. And today, earnings. We should have been talking about earnings. All of this time, we're talking about all these macro concerns in the bond market. Alphabet and Microsoft are reporting earnings after the bell. They are really the big winners of this year, delivering 55% and 37% returns year to date, respectively. At what point can we turn our focus back to earnings and angst that's sort of underpinning people who want to get back to those fundamentals? Sam Stovall among them, Chief Investment Strategist at CFRA. Sam, when can we care about earnings again?
Good morning, Lisa. Well, actually, I think we're caring about earnings currently because that's one of the factors that I think investors are feeling nervous about. It's not just interest rates, it's not just oil prices, but also will we have a fourth consecutive quarter in which we see S&P 500 earnings decline? We're not really seeing an upward move in these earnings forecasts for the third quarter, and I think this will be a very pivotal week for that to take place.
Sam, good morning to you. It's Manus. Where are we most at risk in this earnings season? We've got big tech, a little bit of big tech today. We've just had GM remove their guidance. They've removed their guidance because of the strikes. But where are we most at risk in this earnings season?
Good morning, Manus. Well, I think the at-risk would be where the greatest expectations are. Consumer discretionary expected to see about a 15% rise in year-on-year earnings. Communication services up 27%, so very strong advances there. Conversely, the bar is set so low that you are reminded of an old adage that rarely do you injure yourself falling out of a basement window for energy as well as for materials and healthcare. So some areas are expected to do very poorly and could therefore end up surprising to the upside.
Now, I'm always impressed when somebody gets up early enough to watch Bloomberg Brief, and Cameron did that for us and reminded me of part of the interview that I had with Derek Halpenny of MUFG, and he's done some backtracking on the Beige Book, and I think he said he'd find the most references to a slowdown in the consumer, a weaker consumer that he'd seen for really quite a while. Is this where we see sort of the lights go on in terms of perhaps the constraint on the consumer, or is that a 2024 realization?
Well, I think that the consumer is still holding up quite well. Most recent retail sales numbers showed that. Employment data is showing that. We do expect, despite the very strong expectations for Q3 GDP, up 5% or more possibly, that we will then slip into a softer mode in the fourth quarter of this year, first half of 2024. So I would tend to say that whatever concerns you would have on the consumer are likely to be pushed out into the new year.
Sam, do you think that as you look to 2024, earnings estimates are too high or too low?
2024, the number has remained fairly constant at around a 12% gain, with a sequential upward move starting in the fourth quarter of this year through each of the 4 quarters of next year. By the end of the year, we're expected to see all sectors in positive territory, with 5 of them posting double-digit increases. So I would tend to say that because these numbers have not really changed, that they are at least where analysts are willing to leave them for the moment.
Do you think as you go into 2024, given that you're talking about better earnings for things like energy and healthcare, which were left behind this year, that you could see a leadership rotation next year?
Well, that's certainly a possibility. What I have found is that the adage of let your winners ride continues when you move from a positive year to the new year. Last year, however, things were quite different. You want to actually rotate from first to worst, meaning that you go from those groups that held up the best during the market decline, such as in 2022, and you move to those that were beaten up the most, which were communication services, consumer discretionary, and tech, the best performing groups this year. So for next year, yeah, you might see an improvement of those groups that underperformed, but following a good year, you tend to let those winners ride.
Sam, how much can you have conviction at all at a time where 10-year yields are bouncing around like a ping pong ball?
Well, first off, when you think of a ping pong ball, the first drop is the greatest surprise, but each successive drop, it's lower and lower. These concerns have been with the market for quite some time, so my belief is that they're having less and less of an impact on the overall market. The S&P is down a little more than 8% with all of these headwinds ahead of us, so why is it then that the market has not reacted more to this? So I would tend to say that investors are looking for any glimmer of hope to start a end-of-year rally.
Okay, if that is the case, is that bullish or bearish, right? I mean, if people are looking for any hope, are they understanding the implication of 5% yields? Maybe not right now, maybe it's now 4.8%, but of higher yields on some of these companies that still have very low financing costs left over from the pandemic era?
Well, I think that because this higher yield situation has been with us for a while, 525 basis point increase over a year and a half certainly has been a record pace. And I would tend to say that because the market has held up so well, that investors do expect some sort of a slowdown, but certainly not a collapse. So I would tend to say that prices lead fundamentals. And if we start to see an improvement in those prices, then fundamentals are likely to continue to improve in 2024.
So a drop but not a collapse. And in terms of the biggest risk is perhaps the capital movement from bank balance sheets to elsewhere. How concerned are you that there's something a little bit more malevolent coming down the pike in terms of the banks, like we saw in the springtime with some of the bank runs?
Well, I would say that the regional banks are still going to be having their challenges. Expectations are for about a 26% year-on-year decline in earnings for the third quarter. That's expected to last into 2024. Yet we started the quarter with the large banks expected to show less than a 3% earnings increase. Now that earnings gain is forecast at 16%. So the behemoths are actually doing quite well and are really holding up the banking universe. I would tend to say that typically banks are doing well in the first year of a bull market, which is not the case this time around. It is a bifurcated situation with the large banks holding up well price-wise, whereas the small banks really being underwater.
Fortress Diamond kind of reigning supreme. Sam Stovall of CFRA, thank you so much. And talking about JP Morgan, Jamie Dimon scheduled to speak any moment. If you are just joining the program, we are seeing a bit of a lift to the market. Bonds kind of trying to find direction after a tumultuous period. S&P futures up 0.5%. Manus, I'm glad that you mentioned the banking sector. And Cameron, I'd love you to weigh in on this, because something that really people have not been talking about are the regional banking stocks. And they've gotten absolutely hammered, and they're actually trading very near the lows going back to March. Are we missing the forest for the trees when we talk about a crisis averted? Has it been?
Well, we have to consider two big things. The first one, of course, is slowing loan growth and how much of that drives their ability to continue to drive that net interest income. The other part of it is the balance sheet, because we know as yields have gone up, they have that held to maturity loss that continues to swell. The Fed is allowing them to push out having to recognize that loss because of the BTFP program that they put in place during the bank collapse. That expires in March. So how much longer are we going to be able to push off that kind of realization of some of those balance sheet issues?
That, to me, is one of the big questions. And Manus, I think it's good that you brought that up, because are we seeing things break just slowly?
Yeah, I mean, we're used to these cataclysmic things just happening right in front of us, sort of overnight or over a weekend. But look at the issues coming at us on multiple fronts, not just from the bond market, geopolitical risk, oil prices, and a number of people coming in around this desk and other desks and saying you're going to get a second wave of inflation next year, and that perhaps. Well, okay, you're shaking your head.
I'm not shaking my head about that. I'm just saying, what more? Like, not another thing. I mean, is it going to be Existential Tuesday? I hope not. You know,
it's only Tuesday. I get a day off tomorrow.
All right. No, I'm shaking my head for that reason, because who knows? This is something, a theory that we've been hearing about, and we'll talk more about that coming up. We'll also hear from JP Morgan's Jamie Dimon in conversation with Carlyle co-founder David Rubenstein. He came out and said that some of those forecasts from central bankers have been 100% wrong. Some fiery words.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
The Federal Reserve is going to have to raise rates higher, which probably will mean by 25 we may have a soft, we may have a hard landing. That is the only way I see how we're going to be arresting this, but I don't expect it anytime soon.
Larry Fink, BlackRock CEO at the Future Investment Initiative in Riyadh, as people try to grapple with the idea of reinflation next year. This is something that we have been talking about. Manus brought it up just moments ago. Manus Cranny and Cameron Dawson, CIO at New Edge Wealth, both with us right now in markets. We can see a bit of a lift. We do see those earnings coming out. And Cameron, it's just been catching my eye. Everything has been beating.
Yeah, much better than expected. When it's looking at the consumer better than expected, some industrials better than expected. We just got Sherwin-Williams come out. They raised guidance significantly. That's a housing-related stock, right? It's paint, people spending more on their houses. So clearly the consumer in these earnings is holding up better than expected, somewhat confirming that better retail sales that we got in September.
Do you think the whole narrative, the whole story about excess savings running off is we're overplaying it when you look at the wealth report that we both, all three of us looked at yesterday? So do you think the excess savings narrative dropping so aggressively is folly? Should we, the resilience of the consumer is abound in these numbers.
I think that it's a fading tailwind, but
Okay.
it's not a headwind because the consumer balance sheet is healthy.
The risk is it turns into a headwind in 2024. That's the debate, isn't it?
Certainly, but if you look at things like consumer credit cards as a percentage of disposable income, they're just back to their 2019 levels, meaning that it's gone up a lot. Consumers are using more debt, but it's not nearly where it was during the great financial crisis. So assets have been growing faster than liabilities pretty much consistently for the last 7 years. The consumer balance sheet still is healthy, even though at the margins it's deteriorating.
So there's a real sort of bigger picture question about composition, and we were talking about this with Tom Sisouris yesterday when he came on and said what you're seeing is that the Fed policy rates have really affected lower income individuals and smaller businesses disproportionately. You have seen this again and again. So when do they start to have a bigger impact on the overall general narrative, or can you see this dispersion continue where the overall averages keep chugging along?
Well, the thing that lower income individuals and smaller businesses have in common is that they tend to have more of that floating rate debt. It's bigger companies and higher income people who are able to term out their debt, borrow at 30-year mortgages or issue 30-year bonds. And so it's those larger borrowers that have not been pinched by these higher interest rates. It's why small caps and micro caps are underperforming so much. They have more floating rate debt.
But we were just chatting about this in the break. As Gina left, I said, I thought we were supposed to run into some kind of a significant debt cliff moment for corporates, refinancing. They have refinancing. Now, we haven't made a huge deal out of anybody missing the refinancing yet. But as you look at debt costs going forward and you look at the returns going forward with debt costs, surely that begins to impinge as well.
Well, certainly, because eventually you have to refinance that debt. And if you look at the corporate treasury market, or corporate bond market, a lot of them have average yields that are less than the entirety of the treasury curve. So eventually you will have to refinance at these much higher rates. And that's the reality of higher for longer starting to bite.
This is what everyone thought, okay? And this, to me, I'm so glad you brought this up, Manus, because to me, there's been this sort of overhang Back in 2015, 2016, we were talking about beer goggles. Dallas Fed President Kaplan came on and said, everyone's looking at this world with beer goggles of low rates, and that's why they're buying anything. Anything can look beautiful when you go out and you take a look at assets with low rates, with zero rates. And now you're expecting Armageddon because you've had a world refinance at that, and you haven't. And that's really sort of the surprise. How much can companies survive by just basically relying on investors to force them to stay afloat so the investors don't get totally slammed with losses, right? I mean, this is something that you've been seeing with helping refinance at decent rates.
I think we're just now starting to see the pinch come through because we've been in this for 18 months, almost 2 years now. That's allowed extend and pretend. You can try to push off the refinancing as much as possible because remember, we're also conditioned for the Fed to come in and cut rates really quickly. And the Fed's telling you they're not going to do that. So it's the reality setting in that, hey, I've delayed refinancing as long as possible. Now I kind of have to face the music, and the end result is much higher rates.
So how have you shifted your views over the past couple of weeks?
Yeah, so we have been underweight duration for the entirety of the year, thinking that there was this floor under interest rates because of that higher for longer and an upward bias to interest rates. But now we're starting to see a world where the risk reward simply looks better. If you take a 100 basis point move higher in yields versus lower in yields, at least you have this higher base yield offsetting some of those losses. So when we think for long-term investors, we're starting to find interesting, compelling opportunities, not just within treasuries, but within munis. We're not tactically going full overweight duration, saying the peak in yields is in. There's still a lot of risk, but that's where we're starting to find opportunities at the margin.
I was almost going to give Cameron sort of like her introductory drum roll, because she's in good company, isn't she? She's got Whaley from BlackRock. She's got Alliance alongside you. So what goes through my mind, and I'm going to slightly combat you there, which is, isn't it just fear of being left behind that you've got to pivot on your duration call?
Certainly, of course, we don't want to be too cute with it with the timing, but we're long-term investors. And if you think of it just in terms of asset liability matching and thinking about strategic allocation. So if I say to you then, you're shifting,
is it a dramatic shift in your taking of duration, or is it incremental madness? In other words, we see an opportunity and we add incrementally?
It's incremental because tactically we have not made this call that we say we've seen a peak in yields. We still see this supply and demand issue where we do know we have higher deficits, and that is increasing supply at the same time that demand is falling. QE is not here to save the day. We don't have the flight to safety bid yet. We'll have to see how data emerges. And we shouldn't forget, we have this big unknown about the Bank of Japan and potential changes to yield curve control policy. What could that mean for demand for treasuries as we go into 24?
Do you think that that could have been underpinning some of the wild moves over the past couple of days?
You can track the ownership of treasuries by Japan, and it's actually gone up slightly. They've sold more corporate bonds, so I don't know if that's necessarily, but it is the fear that they could be less buyers on the margin.
Just I'm wondering though, just going forward, when you talk about how you are legging in just on the margin to duration, is it out of equity risk? Because we heard this yesterday from Katie Nixon.
Yeah, you have to do it in a very tax-efficient way, because if you're selling equities with big gains and layering into bonds, that may not be the best trade. One of the ways that we've been doing it is saying if we have dividend income, instead of reinvesting into equities, we'll reinvest into fixed income, because at the end of the day, if you can get your same return at less risk, then maybe you should do that. Now, how unrisky is long bonds, given the fact that the TLT is down 45% in the last 2 years?
Listen, you know what? When you get to my juncture, you sort of say, you know what? 10-year paper actually doesn't look too bad. Maybe at 5%.
Well, that's what a lot of people seem to say. Basically, it got 5%. The market basically said we reject that. No, we're going to pounce on that.
But it comes actually. You're back into sort of general historical norms, if I'm not wrong. I mean, we are. Many people out there are flummoxed by rates at 5%, paranoid at the risk of 5.5%. The reality is, when I took my first mortgage in 1994, it was at 7% in the United Kingdom. I have lived through 7% and 15%. So for me, it was free money at zero. It was free money at zero. Now I'm choking at 8.
I've got to be honest. These conversations, when people say this kind of stuff, they kind of bug me a little bit.
Why?
No offense, but just because the world was so different then. Prices were different. They were more adjusted to a 7% rate. How much do the prices of assets change the scenario when you have high prices that were backed by low rates, and then all of a sudden you've got to deal with the rate going back to where it used to be.
Yeah, you were able to see house prices go up 20% coming out of the pandemic shutdown, simply because the average mortgage rate did not reflect that, because mortgage rates were falling so much, or the average cost of paying for that mortgage. So now when you add very high prices to very low interest rates, that's where it becomes simply unaffordable.
Torpedoed.
No, you can come back at me next time, because honestly, you are correct, and I think that it's a valid point. But so many people have come on here and said,
it's really
you weren't around. Well, you weren't around, but I remember I took out a mortgage. It's like, well, you know, come on, it's a little bit of a different scenario. Coming up, we're going to have a conversation with the GM, with GM.
Ackerman has quietly emerged as one of the key architects of modern sports. As the founding president of the WNBA and now the commissioner of the Big East Conference,
Commissioner Val Ackerman.
Ackerman has a knack for being at the most important tables at the most critical times.
I want to thank Val Ackerman here as well.
Val Ackerman.
I had a big part in this, in how USA Basketball and the NBA could come together to support the women's national team. I feel like we really have proven something. And for me, in my personal role, whether it's in basketball, whether it's helping women, whether it's trying to help college sports hold on to the things that have made it such an important institution, I really do believe deeply in the things that I do and how we can make a difference. And very glad that the Big East has a role to play in the circles that we're part of. I just hope that the momentum we've begun to see continues and builds in the years to come.
Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John off, maybe shopping at Hermes, maybe going on a cruise. I know that John loves those. Menace Crenny here with us, as well as Cameron Dawson of New Edge. We're very happy to say, seeing a bit of a pop in the markets, especially as we get earnings trickle out through the day. Maybe today will be the day the earnings will take the narrative over from 10-year yields, because that has been the narrative for months now. S&P futures up 0.6%, climbing from earlier. 10-year yields just up marginally higher, but really sedated unsedated, considering where we've been. 4.87%, crude popping by about 0.5%. Euro softness after what we saw out of that region economically. Under surveillance this morning, Hamas releasing 2 more hostages as a potential ground invasion by Israel into Gaza is delayed. National Security Council spokesperson John Kirby saying yesterday that U.S. officials are in talks with Israeli officials about a possible offensive, but would not dictate terms. French President Emmanuel Macron is the latest world leader to visit Israel and is meeting with Prime Minister Benjamin Netanyahu today. And Manis, to me, it seems like there is a shift in tone from the U.S. government, as well as from other governments around the world, trying to push for maybe delaying or putting off some sort of ground invasion indefinitely to try to get some of the conflict under control.
Well, we certainly moved to some kind of a holding pattern relative to where we were at the close of business last Friday when we went home. Macron, let's see what his narrative is, whether it's a move, a rhetoric around ceasefire, which is what the gathering of the Arab nations in Egypt over the weekend were perhaps saying there was not enough of a discussion around that. But you're right, we seem to have shifted into a holding pattern. That holding pattern has had a significant impact. It's, I think, from the U.S. side, pushing to tell us what the strategy is, tell us what the end goal is, and tell us how you see Gaza post any, let's say, taking out of Hamas inside Gaza.
Cameron, there's been this question around how to understand the signal from the noise in this horrific conflict at a time where U.S. government officials have come out and raised the issue of imagery, some of which is manufactured, some of it is not, the battle of information. What are you looking for to understand what we're even dealing with at a time of a fast-moving conflict, and one that people say could have influence over assets and everything else, but it could not?
I think the best signals will be from oil and from gold. And oil prices moving higher will be an indication that it could be a broader conflagration, and gold moving higher would be a signal of that flight to safety bid. And if either of those reverse lower, then maybe it's that sigh of relief that issues are contained and we can get towards resolution. Moving higher could be a signal that things could get worse.
And there's this also issue of the U.S. ability to respond. House Republicans trying to get their act together with a vote today on a new nominee for Speaker of the House. Not sure if there are 9, not sure if there are 8 candidates. Multiple rounds of voting are expected to take place behind closed doors, with Congressman Tom Emmer of Minnesota seen to be the favorite among 8 candidates. It feels like it's important, Cameron, for there to be some sort of, I don't know, resolution to this leadership at a time when people are looking to the U.S. to be able to respond, not just this, but also a government shutdown, also the potential for a budget deficit that's climbed by $1 trillion over the past year.
Yeah, exactly, which is, it's probably one of the reasons why you've seen this uplift in yields, is just that there doesn't seem to be any appetite for budget restraint. And if you look, even the Congressional Budget Office has, which tends to be a little bit more aggressive assumptions, has the deficit only improving to 6% next year as a deficit to GDP. That's still really high in a world where GDP is projected to remain strong. So what happens if GDP were to weaken and we actually have a recession and you have those counter-cyclical measures kick in? Where does the deficit go then?
Well, that deficit funding is part of the biggest issues in the bond market. And a lot of guests come in, they sit down, they talk about supply, and they talk about that mountain of supply to the bond market. And at some juncture, if you don't have the natural buyers of banks, the natural QT, and you don't have those natural bulwarks of the bond market that have been there for 10 years, and if the structure of that has changed, that's when your risk changes from the supply side.
Especially if you don't have the price-insensitive buyers. That was Dalip Singh of PGIM Fixed Income, his point earlier. Talking about price insensitivity, Coca-Cola raising its full-year outlook, citing stronger performance this year despite price increases and other consumer pressures. This key example that Cameron noticed right away, price mix or price changes across a range of products and packaging increased by 9%. Analysts were expecting a price mix increase of 6.2%. And guess what? Volume still increased by 2%. And to me, Cameron, this really highlights where we are, that companies are still passing along price increases, and they're still increasing the volume of sales.
That is so important, because what we've seen in other companies is that if you raise price, you give it up on volume. But the fact that you're able to keep hiking price and continue to have volume expansion shows you that the consumer is absorbing those prices. But then it's the guidance about next year. Can they continue to raise price at that mid to high single-digit level? What does that mean for revenue growth? And then what does that mean for margins?
You know, it's interesting. We talk about demand destruction often inside the oil market, the commodity commodity market and the super cycles there. You look at Nestle, they're also raising prices selectively across, guess what? Two beautiful things, chocolate and coffee. And Netflix raised their prices. So the whole, and this is where I'm curious in terms of the equity allocation, is it a little bit more consumer discretionary, even though you see some of the tailwinds turning to headwinds next year? In the interim 6 months, is it still a little bit consumer discretionary?
Well, we are seeing less pricing power in bigger ticket items. So Tesla, of course, is having to cut its prices, which shows you that consumers can still handle the lower ticket items. It's not eating into their budgets as much. For us, the most important ratio to watch is equal weight consumer discretionary versus consumer staples. That will sniff out a turn in the expectations for consumer growth. You equal weight to remove the impact of things like Amazon and Tesla. That's still in an uptrend, which just tells you that the consumer is still in an uptrend.
Taking a look at some of the other stocks that kind of speak to that uptrend, just want to look at Verizon, shares popping. I heard that, some people on this desk have helped that. Menace, including Fios, really helping the profitability there. Those shares up 4%. General Motors, shares up 1.7%. At one point, they were up about 3.5% after really beating earnings, but they withdrew guidance on some of the strikes. And we're going to be speaking with Paul Jacobson of General Motors about that shortly. And Coca-Cola, we were just talking about that beat, up 2.3%. So it's sort of interesting to see how the response to this, decent but muted, and that has been sort of the overarching response. Let's see what we get after the bell with Microsoft and Google. Right now, to understand really how this is playing out beyond just the U.S., Damian Sassower, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence, joining us right now. And I do wonder, we're talking about the volatility in the Treasury markets, how much you see the spillover really kind of happening in the developing world, that basically DM catches a cold and the rest of the world catches a flu.
You know, Lisa, I just can't get over the fact that anything Menace says, it's almost like he's complaining about prices in the U.S., like since he's been in the seat. But for me, really the price you need to look at mostly is the price of oil. So I have to agree with Cameron here. I mean, you haven't really seen yet, as we have seen in past episodes of conflict in the Middle East, oil prices really kind of spike it. It takes some weeks for it to really filter in to oil, and oil prices obviously are the mechanism for which to do that. What's interesting, though, is when oil prices go, so go credit spreads here in the U.S., and that includes emerging market credit spreads. So that's kind of where I'm focused on, because outside of that, if you look at reserve adequacy levels, if you look at current accounts across the whole of the major emerging market complex, things look kind of okay, you know? And even if you look at refinancings, you look at frontier in places like Argentina and, Vietnam and Ethiopia and all that, yeah, things are going to get a little painful for sure.
Yeah, just for the record on the whole sort of price rises, you just got to set the record.
Netflix, Tesla. I'm here.
I haven't got a Tesla. I have got a little bit of Netflix. I'm just grateful for the visa. So let's just keep everybody off. I don't want an anti-Irish sort of momentum building against me. On the note, you name a number of big risks there. The oil market has been incredibly well behaved. This is my humble opinion, incredibly well behaved in the light of some serious geopolitical risk, with constraint from Russia and Saudi Arabia at the same time. When you look at emerging markets, we've run our analysis at Bloomberg, and on a major escalation, oil could get to $150. As you look at credit, on an escalation basis, what kind of warnings, where is the most at risk? Who's swimming without any, who's there with when the tide goes out with the shorts down in credit?
Well, it's Southeast Asia, right? I mean, the Asian currencies are already reflecting that. I mean, they are oil importers. They're ones with, you can actually see that a lot of their central banks are actually finally reacting to inflation. They're hiking rates. Indonesia had a surprise hike just the other week. So, we're seeing, I think, if oil prices do rise, you're going to feel it the most in Southeast Asia. You'll probably see that reflected in the currencies initially. What's interesting, though, about EM currencies and commodity currencies in general, I mean, if you look at Colombian peso and a lot of these proxies for oil prices, they're really not correlated the way they were in years past. And Latin American currencies specifically, we got some better than expected data out of China last week. You'd have thought that maybe, you'd see a better reaction to that Chilean peso and what have you, but they're just not reacting the way we've seen in years past. And that gives me a little cause for pause.
We see this better data from China, and yet yesterday we had the Shanghai index close below its October 2022 low. What drives that higher?
Oh my God, you're talking about foreign investment in Chinese equities. I'm not going to go there. But yeah, I'm a fixed income guy. But look, the reality is I think demand for anything that's non-dollar denominated in this market, it's going to be that much more challenging given what we're seeing out of the Middle East, right? I mean, I think, you know, we've seen the move in safe havens. We've seen the move in Swiss franc. Yen has yet to react. I think that's the one we really have to keep a close eye on, quite frankly, Japanese yen. And so if I had to look put my macro hat on and kind of look at where, you know, things aren't moving as quickly and kind of reacting the way they would, Japanese yen really stands out to me as one where, you know, if you are kind of looking for a safe haven and you're looking for one that hasn't really followed the masses, you probably look there.
You're such an expert at this. You just say, I'm not going to talk about this, then you talk about Japan. But I do really want to double down on Cameron's point, because there was some interesting stuff over the week. So,
you've opened Pandora's box here.
To be honest,
I do this all the time now.
Xi Jinping came out and he made this unprecedented visit to the People's Bank of China, seeming to signal he cares more about the economy. So it raises this question about stimulus.
Yeah.
Do you buy into that, or do you just basically say, I'm not going to go there. It's not investable for me, maybe other people. And so, you know, if you want your analysis, go elsewhere.
Well, I think, you know, Cameron, and look, I mean, I'll defend this. Is 0 the right number to have in terms of Chinese exposure in your portfolio? Probably not. Now, the question is, how do you want to get your China exposure, right? Do you have the flexibility in your mandate to go to Chinese equities, to go to Chinese credit, to go to, you know, Chinese high yield credit, property credit? Probably not, maybe, I don't know. I mean, certainly it's in a lot of your EMB or your EM ETF, sorry, to throw acronyms out there. But, you know, for the reality is, yeah, so it's probably not 0, but, you know, is it 2, is it 5, is it 10? That remains to be seen. To me, it just seems like a trade. It seems like a trade on a rebound in Chinese growth. It seems very directional. It seems something that, you know, yeah, it doesn't seem like it's got this, you know, the sustainability for multiple quarters to play out. It seems like a trade to me. So that's kind of how I would play it.
Damian Sassower, thank you. And that's wisely said. So I appreciate that. At Bloomberg Intelligence, it's so difficult to really game out what's going on. What we are seeing right now is a bit of a pop in markets in the heels of U.S. earnings. S&P futures up 0.6%. And Cameron, I'm not going to totally let you off the hook either, because there is this question about what you do with the stories coming out of China, and this question of Xi Jinping going to the People's Bank of China, and this idea of the possibility of stimulus, but then a fundamentally changed economy where U.S. companies are really moving out of Hong Kong, anecdotally and by data, at a pretty significant pace. How do you play it?
Yeah, we usually have a policy of not trying to catch falling knives in a highly uncertain regulatory environment where I have no information edge. However, there's a point where something gets so oversold, so unloved, so uninvestable that it starts to look interesting as a trade, not necessarily as a long-term investment. So anything in the area has to be done in a very risk-managed way, because we see this great uncertainty from a policy perspective that, frankly, I don't have any edge on in order to get a read on.
It's amazing how last year BlackRock were with me when I was in the Middle East and said, quite frankly, we can live without China, a little bit of China for the moment. So we go through these moments of change in markets. Next year, how important is it, because we're on the cusp of deflation, disinflation in China. How important is that for the world in terms of what happens next in China in terms of stimulus?
It's extraordinarily important, mostly for cyclicals, because China is a cyclical buyer of things like commodities and everything that feeds into that ecosystem. And I thought last week, which was really significant, machinery stocks started to trade really poorly, despite the idea that the PMI is going to be recovering early next year.
I love what also Fadi Birol of the IEA had to say, that maybe it's not going to make as much of a difference to oil prices anyway. Coming up next, Paul Jacobson, CFO of General Motors. He is going to talk about withdrawing guidance as a result of some of those strikes.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The bottom line is we've got cards left to play, and they've got money left to spend. That's the hardest part of a strike. Right before a deal is when there is the most aggressive push for that last mile.
Sean Fain, UAW president, speaking last Friday, maybe indicating that we're reaching that last mile, maybe not. We are focused on the auto manufacturers at a time of great uncertainty. I want to get right to it because we have a fantastic guest with us to understand what the implications from some of these labor negotiations are going to be longer term. Paul Jacobson, CFO of General Motors, joining us now. You did report earnings earlier this morning. You beat estimates, but you withdrew your $14 billion profit forecast because of the uncertainty due to these strikes. Do you think that it will materially affect the outlook given the contours of where negotiations are right now of 23 to 30% increase?
Well, good morning, Lisa, and thanks for having me. You know, just before I start, I would like to just give a big thank you to the entire GM team for an outstanding quarter across the board, including the employees that are working every day and producing the high-quality vehicles that our customers love. It's a strong testament to everything that we're going through right now. You know, when we made the decision to withdraw the guidance, it was really based on not wanting to speculate on the length or scope of the strike. You know, clearly this has been a very different UAW leadership strategy and one that we've adapted to. But at the same time, given that we don't want to speculate where the next plant might be or how long that might be out, we thought the prudent thing to do was to withdraw guidance, despite the fact that the underlying business was actually performing at the top end of our range prior to this. So we'll provide an update with investors as soon as it's over, but we're still focused on making sure that we execute every day.
Can GM make a profit with a 25% raise for the UAW like Sean Fain has requested?
You know, what we need to do is obviously strike a balance. We've said from the beginning that we really want to reward our people for the quality work that they're doing at each and every plant, each and every day, and that's a testament to the demand that we've created for the vehicles that we're producing, which I think is the best portfolio in GM's history. So what we've also got to do is make sure that we sign an agreement that allows us to compete in the global marketplace. When we look at the pressures and the challenges on EV profitability, as well as some of our foreign competitors, we've got to make sure we can continue to price our vehicles and produce our vehicles profitably, which gives us the cash to be able to invest in the next generation, not only the models, but the plant refurbishments and the transformations that we have to do. So we've got to be able to strike that balance of rewarding our people, but making sure that we're absolutely able to invest in our future.
Does 25% allow you to strike that balance?
You know, I think it does. We're not going to sign a deal that doesn't allow us to be competitive. You know, there are obviously challenges that the team's responded to over the last few years, whether it be COVID or the semiconductor shortage or supply chain issues. The team's been remarkably resilient, and I think this is another challenge, but one that we can rise to, and I believe that we can still hit our goals.
Paul, very good morning to you. You've withdrawn the guidance. We've cleared that away. I'm curious to know, if you're withdrawing guidance, is there any risk to anything to do with dividend? Any guidance on that? Obviously, dividend and buybacks were reinstated just last year after a 2-year hiatus. So is there any quirk there?
Well, Manus, I would say that, our balance sheet is incredibly strong right now with about $50 billion in total liquidity available to us. We went out and we got an additional line of credit about a month ago to make sure we're prepared, because while the uncertainty and while the team is working at the bargaining table in order to try to find a deal, we've got to make sure that the business continues to run. We make the investments we can. We fulfill the commitment we've made to our shareholders, and we continue to do business as usual the best we can. And the strong balance sheet is going to enable us to do that.
As I was sort of getting more familiar with the dynamics of this strike, I've just landed in this country after 5 years somewhere else. The question that goes through my mind, to close these strike deals and to deliver on pensions, it's a very British thing. I'm curious, do you have a number that you will have to contribute to the defined pension? This is one of the most contentious parts of the negotiations, as I understand. So is there a number that you're going to have to make good on restitution to the pension to make this deal good?
Well, our defined benefit plan, which has been frozen for quite some time, is actually funded very, very strongly right now, and we feel good about that. The participants participate in a defined contribution plan where, under the current agreement, we contribute 6.4% before an employee has contributed anything. So there's a good balance across the retirement plans, and we think one that's very favorable, and one that we've been able to adjust the business to make sure that we can put into the calculus going forward. So anything that we do to retirement goes into that bucket of what I said earlier, which is we need to be able to compete in the global marketplace, and where we spend our money isn't necessarily as important as how we spend it. So we're really trying to strike the balance as to what's important with the UAW.
If you had Elon Musk in front of you now and you were talking about prices, I bet you wouldn't be having a nice conversation. I mean, how brutal have his price cuts been for your plans for 2024 in EV?
Well, when you look at what our average transaction prices have done this year, they've actually been remarkably stable in the midst of it. Now, that's primarily the internal combustion engine portfolio, which I would say is not necessarily a direct competitor with EVs, although EVs do work to try to disrupt ICE vehicles as much as they can. So it's one that we've been really competitive. When you look at our EV slate, we've kept our pricing very stable, and while we're delivering in smaller quantities than some of our competitors, we are expanding rapidly. We have a strong order book that we're fulfilling, and customers have stuck with us through this. So in the third quarter, we produced about 2x the number of Ultium platform vehicles as we did in the second quarter. So we're growing rapidly, and pricing has been very stable for us and our products, and our customers have stayed with it.
Paul, do you think that the prices of vehicles are going to go up because of the strikes?
Well, we've seen some tension, and obviously when you look at the inventory levels, there's a little bit of challenge. We saw some increases in the used car market in particular, leading up to the labor stoppage. So we're watching that closely. Obviously, the consumer has seen a lot of pressure on monthly payments as a result of higher interest rates over the last couple of years, but that's something that we strike a strong balance with. But it all starts with having strong demand for your portfolio of vehicles, and right now GM's got a very, very good demand book.
How much is demand starting to wane, though? Especially you talk about taking out loans and how much interest rates have gone up, and we've seen that subprime auto loans are seeing delinquencies at rates that are unprecedented in data going back to the early 1990s. How much is that impacting? How much do you expect demand to grow going forward?
We really haven't seen much of an impact, Lisa, on that demand. It's been pretty consistent. So when you look at our average transaction prices, they're actually up year over year. Wholesale volumes were up about 2% in the third quarter. They've been up about 8% year to date, and inventory hasn't built. So we're moving the vehicles that we're producing, despite the fact that monthly payments have gone up and prices have gone up. So I think that's a strong testament to the products that we have. We've obviously got to watch that and make sure that we're running the business to be resilient. And that's one of the things that we have to strike in the labor negotiations, is we've got to strike that balance of making sure that we're rewarding our people while balancing the need to compete in the global marketplace.
Just real quick here, Paul. Can the U.S. truly compete with China when it comes to EV production, when it comes to EV sales?
Well, I think when you look at what Tesla's done, when you look at the infrastructure that we're building, not just in the battery joint ventures, but also in the raw materials, we believe we can be competitive with China. And our vehicles that we've gotten out, the customers love them, and we think there's a lot more to come from the General Motors team.
Paul Jacobson, General Motors CFO, thank you so much for being with us. Cameron Dawson, final word from you on how much you're looking at auto manufacturers and some of these potential labor negotiations and challenges coming to the fore.
I think that'll be a really important indicator about wage pressures and margins going into 24 because the labor market still is very tight. There is negotiating power for labor. So if you continue to see that, you have to square that then with pricing power of companies because if that starts to fade, your cost could still be going up, and yet you'll have less ability to pass on that increased cost to your end customer.
Are you buying automakers?
No.
That was one of the longest sentences. That was brutal.
We are long-term quality investors, and these are great franchises. However, we care about balance sheets a great deal, lower leverage, high free cash flow, high return on invested capital. These typically have been very capital-intensive businesses, not with those conditions.
Cameron Dawson, come back soon. Wonderful to have you. Thank you so much for all your insights of New Edge Wealth Management. Coming up, we will have words from JP Morgan's Jamie Dimon, which has been delayed. We will bring that to you. We're also going to be speaking with Matt Luzetti of Deutsche Bank.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Those higher interest rates are going to bite all corners of the economy.
The bond market is helping the Fed slow the economy.
By the time we get into the first quarter of next year, I think we do have a mild recession unfolding.
One way or the other, Fed will lower inflation and continue to lower it.
If you look at equities, it has yet to reflect the higher rate environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I think we can say today is about earnings, at least so far. Welcome back. This is Bloomberg Surveillance from New York City. Menace Cranny alongside me, as well as Matthew Lazzetti of Deutsche Bank. John and Tom both off today, I believe taking a cruise together in Cairo. Right now, though, we are looking at a situation where we've been wondering when we can stop focusing on what we're seeing in the bond market and look to earnings. Matt, so good to have you here.
It's great to be here. Thanks for having me.
I wondered, from your perspective, I mean, don't you feel like at this point yields have taken on a narrative of their own, even away from economic data, even away from some of the machinations in the global markets?
Absolutely. I think that the bear steepening that we've seen in the curve over the past several weeks and months has really driven everything. I think as we woke up yesterday, you saw the 30-year yield near 5.2%, and really just the big reversal that we saw yesterday driving markets at the moment. It's also driving central bank policy. I think what we've heard from the Fed is it's a really important driver for why they're not going to raise interest rates next week. I think it's a really important driver for why they're a little bit concerned about raising rates further. And so it'd be really important whether or not this reversal that we've seen in the long end of the curve is sustained, or if it's just a blip with the train that's moving forward.
Well, at 486, I mean, they're up 5-6 basis points this morning. So here's the conundrum, isn't it, for the Fed? If the dirty work was being done by the bond markets at 5% and higher on the longer end of the curve, are they going to be uncomfortable if these yields begin to retrace more materially than what we saw yesterday?
Yeah, I think that is definitely the conundrum for them. They talk about it doing some substitution in terms of rate hikes, but to the extent that unwinds the move, that it eases financial conditions, especially with the backdrop of the data that we've just seen over the past several months, I think that is an uncomfortable one for them. And so it's this give and take that the Fed has to manage, and it's certainly not an easy one for them.
But Manas, it seems like yesterday everyone was talking about just the wild ride we were seeing. And today it feels like we're able to look a little bit more at the earnings that are coming out better than expected. And to your point earlier, and it's a good one, when do we start to worry about reacceleration of inflation?
Which is something which is 2024, and I think that this is the risk in Europe. I think it's more, we've just had a conversation with the GM CFO, and again, he's talking about pricing and his electric vehicles being stable, but he's going to pay 20, 23, 25% more for his labor when this deal is done.
Right. Well, and though that said, he did say if and when this deal is done, they did withdraw their guidance because they don't know when the deal is going to be done or what it's going to look like. But he did say they would still be profitable, even with a 25% increase in wages for the UAW workers, which raises a question, hey, is there a lot more to go? I mean, not just with the auto manufacturers, but elsewhere. Do you see that increasing in terms of wage pressures?
Yeah, I think you've seen a lot of heterogeneity. I think over the summer, the Fed was getting a lot of confidence that we're seeing the labor market come into better balance. The quits rate coming down, job openings coming down, the unemployment rate edging higher. Leading indicators for wage growth were quite positive. I think there's just been a tremendous amount of uncertainty from the latest batch of data. The jobs report that we got was so strong, a leveling out in job openings, retail sales that surprised to the upside, the CPI report that was a little bit stronger than expected, but with a really bad breakdown from the Fed's perspective. And so I do think we are entering a couple of months here where from the bond market's perspective, you do see somewhat more elevated inflation than we were seeing over the past several months. And the question is, does the real economy slow enough to keep the Fed at bay?
And stocks are up today, if you want to take a look at that data. And honestly, the fact that stocks are going to have to look at this toxic or just confusing brew, I would say, more than toxic brew, confusing brew, and try to make sense of it every day gives you a sense of why people are just sticking to their guns and looking day to day. And actually, equity market volatility has been much less than in the bond market, which is something we were talking about earlier with Gina Martin-Adams. S&P futures up of about 0.5%. 10-year yields slowly just kind of inching higher a little bit, 4.86%. 0.7%.
Baby steps.
Yeah, I mean, basically, to me, this is basically stagnant, but the day is young, and we've got a 2-year auction at 1 p.m. from the U.S. Treasury. Euro softer versus the dollar, and I think that that is interesting in light of what we got overnight, the economic data. Europe's still in a world of hurt heading into that ECB meeting Thursday.
Europe is under a lot more risk. Okay, the gas tanks are full going into this winter, which is very, very structurally different to where we were last winter. But if you look at that euro dollar, there's a resilience in that euro dollar. A lot of people came on the various shows that I've been on calling parity, calling 95 at one juncture, and yet the euro endures. So I think let's see what Christine Lagarde has got to say this week, which might underpin the euro.
Sinead Coulter-Grant, head of investor solutions at BNY Mellon Wealth Management, you're going to have to answer that question for us. Basically, how much are investors really looking to Europe as a potential point of resilience amid some of the confusion with the U.S. and the debt profile, or really the point of weakness, which is what the sort of consensus has been for the past couple of months?
Very interesting question, Lisa. Hard to look at Europe as being an area of resilience. So we know that when the Eurozone economy is firing on all cylinders, you're looking at growth in the 2–2.5% region. And we're very far from that now. I mean, we've already had Germany effectively flatlining for the last couple of quarters. The thing about the US economy that's been so remarkable has been the fact that growth has been so resilient. When you translate that into a currency environment, it's unsurprising that the euro has now started to weaken, really as markets have started to realize that the ECB can't continue raising rates because the economy is stagnating. So it's a pretty unimpressive picture. And when you look at the currency weakness, there's probably more to come.
So the argument would be, a couple of guests came on the brief, shameless plug, it comes on before your show.
Want to keep going?
Is that we're already in policy error? I had a guest last week who said to me, we're already in a policy error in Europe. Would you agree with that? I mean, that takes us back to the times of Trichet and the folly of him raising rates then in the eye of a big storm. Is there anybody in policy mistake at the moment, either the Fed or the ECB? Who's at risk most?
Interesting question, but when we think about policy error, of course, the ECB was the central bank that raised rates in 2008.
Yes.
This time around is very, very different because they have to get inflation under control. The biggest problem a central bank has is when inflation expectations become unanchored. We're not in that territory yet, but we're likely to see more pauses as opposed to the continuous hikes that we have been seeing. I don't think we're in policy error territory yet.
Okay, if we stand back for a moment, yesterday we saw pretty virulent moves at the long end, 30 years, 10 years, all cascading lower. I walked in this morning and I went, why are equity markets just not more virulent on the back of that? And that's the question that I have for you. Why was there not more of an equity kicker on the back of a gargantuan, let me rephrase that, a significant move in the bond market? Let's not over-egg it.
There are many things happening with equity markets at the moment, and earnings are clearly very much in focus. I also think that we're in the midst of a regime shift where we're moving towards much more volatile fixed income markets, right? They have, for the last 2 decades, been much calmer.
Yeah.
We're going back to where we were in the mid-2000s, in the mid-90s, when you actually saw volatility in markets, well, bond markets specifically.
Just maybe return back to thinking about the euro. I think that there's been, the market has been pricing this constant rate cutting cycle from the Fed. It seems to be a little bit reluctant to price that for the ECB. Do you think that that's what is needed as a driver for the euro lower? I think we talk about the resilience, but there's been this big dichotomy in terms of how market pricing has been in terms of the rate cutting cycle.
The ECB operates quite differently to the Fed, as you know. The inflation mandate is a little different, right? They've got that 2% or lower mandate on inflation, which means that they're slower to change trajectory. Now, having said that, the ECB has really never been in this territory before. But look, as we start to see weaker data, we've had that in terms of some of the PMI data this morning. We saw in the UK, in the Eurozone, market participants are going to look at that slowing data and then try to move ahead of the central bank, which will weaken the currency.
And now, in terms of, I'm just looking at your positioning. You are neutral on equities. You favor the U.S. over an international exposure. So with that in mind, when you see this 8% drawdown from July to now, the first question would be, does that reflect enough of a reaction in U.S. equities lower to the higher bond yields? And are you just a natural incremental buyer on these dips?
We're long-term investors, and so when we look at the trajectory of equity markets, we're looking out 3, 5, 10 years.
Okay.
Year to date, we were probably as surprised as most were that U.S. equity markets behaved so strongly in the first half of the year. So even year to date, when you take into account the losses in Q3, they're still in positive territory, albeit driven by 7 major names. That recalibration.
Haaland 7.
Indeed. Or the Magnificent Seven.
The Magnificent Seven.
So as we think about the trajectory for equity markets from here, we're pretty constructive on earnings. There's probably a little bit to come down in 2024 earnings expectations. We haven't seen much of a walk down so far. But we do think that markets have started to price in these different expectations for bond markets.
Okay. Sinead Colton-Grant, thank you so much for being with us. Sinead Colton-Grant of BNY Mellon, thank you. Matt, I have to say, as we talk about how to understand the geopolitics of this, I will say that Europe is one of the biggest question marks. I don't understand the ECB's reaction function. I don't understand how Christine Lagarde is really going to message anything this Thursday.
Yeah, I think it's the perfect environment to wait and see. You know, the Fed's mantra at the moment is proceed carefully, and I think that you'll hear that from the ECB as well. Really not expecting anything on the rate side. I think where the market may be focused is on the balance sheet. So do we get any indications on changes in QT as we look ahead? You know, I think that's a really important development as we think about the bond market, what's happening in the long end of the curve. But at the moment, I think central banks are proceeding carefully. They're waiting and seeing. There's a lot of risks that are out there, and there's nothing that's pushing them to move urgently here.
And what you're seeing with the euro, and I think, Manus, to your point, we do see some euro resilience given the fact that we might be seeing a recession unfold, at least based on the PMIs that you got overnight. The euro 106.28, just kind of hovering in that 106 level, even after some people were calling for parity. Meanwhile, S&P futures just basically hanging out around that 0.5% upward gain, 42.61. 10-year yields, really, I mean, this is basically just stasis for 0.87%. I will say, Advan, I am so glad that you're here because there was a story that caught my eye, that Moody's is starting to use ChatGPT to craft their reports, and this is going to be our artificial intelligence segment for the morning. Do you do that too?
We don't. It is something that I think we're looking into. Certainly not for crafting reports, but in terms of thinking about summarizing big groups of text. So looking through Fed communications, I think it could be a very useful tool as we look ahead. Looking at things like titles, I think it can be helpful in terms of a guidance for reports at the moment. But it is something that we're looking into. I think as you look at Deutsche Bank's research and our head of research, David Folkerts-Landau, he's very bullish, I think, on how AI is likely to drive the economy. I think how it's likely to drive our industry. So it's something that we're looking into closely. At the moment, it is not something that is helping us to write reports.
I think it's going to be a leading thing. I think, first of all, I see my kids using it all the time.
Well, I actually went to do some research for today's show, and suddenly the engine that I was using suddenly populated my page with a whole sort of raft of information. Of course, I clicked off immediately and went and did the proper research. But who can, the AI hologram with a personality? That's all that we need to find. Well, and then I'm definitely out of a job.
Well, this is sort of the issue, right? Is this going to be an efficiency metric that will then remove some of the interns? But what do interns do anymore?
They're overpaid, though, on Wall Street, apparently.
Hold on a second, but do they have a job?
No, absolutely. I think as we look ahead, there's certainly going to be some substitutability, but absolutely.
Coming up next, we're not going to be speaking about this, or maybe we will. His Excellency Omar Razaz, former Prime Minister of Jordan, a really important conversation at a time of incredible tensions overseas. From New York, this is Bloomberg.
Those in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
We know Iran continues to support Hamas and Hezbollah. And we know that Iran is closely monitoring these events and in some cases actively facilitating these attacks and spurring on others who may want to exploit the conflict for their own good or for that of Iran. We know Iran's goal is to maintain some level of deniability here, but we're not going to allow them to do that.
That was John Kirby, National Security Council spokesperson, as the conflict in the Middle East does continue to escalate in certain pockets. The key question being, though, when do we get further escalation even still, bringing Iran more directly into the fold, bringing some of the other regional actors? This is a person who really has deep insight in both the psychology and the geopolitics of the region, and it's really important to get his voice on the matter. Omar Azaz, His Excellency, former Prime Minister of Jordan, currently a lecturer at Harvard. And Dr. Azaz, I just want to start with getting your take on how far things have escalated and what the chances of things truly turning into a full-blown regional war are from your vantage point.
Thank you, Lisa, for having me. Yes, things don't look good as far as I can see. We all live in a global village. Anything that happens today anywhere in the world can escalate into regional and eventually global level, and that affects everything. It affects the economies of the different countries, especially at uncertain times like these. The problem with the approach to the Middle East and the Palestinian-Israeli conflict has been ignoring it, has been assuming that it will go away, has been assuming that, if we create economic links between Israel and countries in the region, then they will see their mutual benefits, and somehow the Palestinian issue will die. This did not happen over the last 40, 50 years, and it's not going to happen. What needs to be done is to address the cause issue that can be utilized by Iran or others, regional powers. The cause issue is that there's still no two-state solution. There have been commitments over the last 40 years for a two-state solution. The U.S. supports a two-state solution where Palestinians and Israelis can live side by side in peace and harmony, but on the ground, nothing is happening. So people in the region are really frustrated. Palestinians have zero hope, and this creates the ground for what we're seeing today.
At this point, Dr. Azaz, where we are right now, how do you go about creating something like that, where Hamas is the leading institution over Gaza and has a real dominant position in society?
Well, the first step is to de-escalate and make sure that humans are not being used in this conflict, innocent civilians. The lack of food, water, medicine is a major issue. Israel has started to allow small shipments of that. This needs to be opened up. The civilians cannot be used as a card in this game. So that's very important. Anybody who's captured during this process, civilians should be returned, and this I think also has started. And so the first challenge is to de-escalate, and the second is to start addressing the fundamental issues here. The Palestinians need a state of their own, and whoever you are negotiating, Palestinians don't choose which Israeli government is. In fact, what we have is a very right-wing Israeli government, and that tends to wants to control all over West Bank and Gaza.
Dr. Omar.
With U.S. and Western pressure, these sides can sit to the table and talk about this ultimate issue of a state, a Palestinian state. Without that, every now and then we're going to get an explosion like we've seen.
Dr. Omar, good morning. It's Manis. I reflect back to the weekend's gathering of the Arab nations. The Jordanian king said during that summit that military solutions don't work. President Macron is there today calling for a resumption of the peace process between Israel and Palestine and the creation of a state by halting of settlements on the West Bank. I mean, do you see this narrative building for a ceasefire? Do you think there's any real possibility of a ceasefire, or will we have to live through some form of ground invasion first?
I think a ground invasion would be catastrophic because there are still over 1.5 million civilians in Gaza. And whenever they move to southern Gaza, they get bombed in the process. So a ground invasion is going to have catastrophic. It will not resolve the issue. It will convince people in the region that this is a one-sided view from the U.S. and the Western allies, that they see Israel as their only ally and they support it no matter what. They give it a green light to carry out what could be seen as ethnic cleansing and war crimes, and that's what His Majesty the King was talking about.
Dr. Azaz, a lot of people would say Israel left Gaza in 2005 and that Hamas did have an opportunity to rule, and you say that the two should come together to come up with a two-state solution. You can't choose the government. But if you have an entity that is designated a terrorist organization and has a goal of killing the other people, how do you negotiate a solution?
Well, first, we can't say really that Israel left Gaza. Israel surrounded Gaza with an iron wall and controls the exit and entry into that region. So it's the biggest open air prison in the world. And I think these types of this becomes a fertile ground for extremists on all sides.
But Dr. Azaz, just with all respect, though, Egypt also blockaded them. There also has not been a willingness for other nations in the region to really open up and to provide more assistance either.
It's, okay, let me distinguish here between opening up to deliver assistance and what Israel and other Western countries have been pushing for Egypt to open up to absorb a wave of Palestinian refugees into Egypt. The first one, the entry to the Gaza from the Egypt side was open until recently, the time it was bombed, and that's when it closed. But the idea that Egypt or Jordan should accept more displaced refugees from Palestine into Jordan and Egypt, that is, the Palestinians don't want it, Jordan and Egypt don't want it, and it's not fair. It's part of the, if I may say, the double standards. Why should Palestinians leave their homeland? and become so desperate. That's been the case for many Palestinians living in refugee camps for the last 40, 50 years. So it's not Egypt and Jordan's responsibility. Ultimately, yes, you might not like your enemy, but you have to sit at the table, whoever it is. And by the way, Israel had the Palestinian Authority in the West Bank. And Israel has weakened that Palestinian Authority. Why hasn't Israel negotiated a Palestinian state in the West Bank? Instead, it does the opposite. It arms the settlers to continue to evict Palestinians out of their homes and out of their lands. So I really, without pressure on Israel from the U.S. and its allies, Israel, especially this government, is continue to do what it's doing, and it's not going to lead to peace, but it's going to lead to escalation.
Yeah, Dr. Omar Razaz, thank you so much for being with us, former Prime Minister of Jordan, as we try to understand how to resolve a conflict that right now does not seem to be in a very good place. From New York, this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
About an hour ago to the U.S. Open, and we can see that lift persisting through the session as we get earnings that do outperform. Tom Keene, Jonathan Farrow, both off, maybe together, maybe alone. I don't know. We'll find out. Manus Cranny very much in, and Matt Lazzetti of Deutsche Bank also alongside me, which is a wonderful and beautiful thing. Seeing S&P futures up 0.6%, 42.65. Yields quiescent. And when was the last time we could say yields quiescent?
That's a beautiful word, quiescent.
I stole it from Tom. I can't even claim to own that. 4.8%. I know, isn't that beautiful?
That's loquacious.
It's mellifluous. Anyway, moving on. We can see in the currency space a bit of dollar strength, euro weakness. I think this is more of a euro story than a dollar story in terms of some of those PMIs coming out a lot softer than expected in the European region. Crude all over the place. Are we escalating? Are we de-escalating? Hard to know exactly what's going on, and crude is going to work through that. I do want to get a catch-up. We've been talking a lot about what's going on in the Middle East, and I do think, Manus, the idea that the U.S. doesn't have a Speaker of the House, the idea that there is so much disagreement, how much does that sort of underpin so much of the discussion?
I think as an outsider, that somebody has just arrived in this country, you look at it as being perhaps on the world stage, not disemboweled, but a weak moment in geopolitics for the U.S. Yes, they're there with the money, and even that's delayed, but it's presumed it will come. But this is a country politically which is really pushing against one another in the capital, not necessarily in the rest of the country. I haven't been outside of New York yet.
Well, when you get outside of New York, you'll realize that it is the rest of the country. Matt, from your perspective, though, how much does this complicate the ability to deal with the deficit, to deal with some of these issues that actually creates a pretty significant drag economically?
Look, I think it no doubt complicates everything. I'm not sure that it creates a big economic drag as of yet. You know, even if we get a government shutdown as November 17th comes up, that drag tends to be relatively limited. It tends to get unwound. You know, we estimated at 0.1% on growth per week. I think the bigger debate, certainly for markets, is where does the speakership end up? Where does the government shutdown debate in terms of fiscal retrenchment, does it lead to any cuts in fiscal spending as we look ahead? The market is focused on supply. It's focused on an environment with a lot of fiscal stimulus in the context of a very good economic backdrop. And so any key changes to fiscal spending over the next year, I think that'll be the key driver for markets.
Of course, we don't know who the Speaker of the House is going to be, and someone who gets to cover that every single day, our Speaker of the House correspondent, Anne-Marie Herdern, down in Washington, D.C. Anne-Marie, what's going on? Are there 8? Are there 9? Are there 7? How many are there? Are there new entrants to the field?
It's a great question. So last night they left this forum, the House Republican Conference, where some of these fresh faces were able to pitch what they would do if they were able to get the gavel. And then we were able to whittle it down to 8 individuals. So it's an 8-man race now. And coming out of that, it does seem to be the individual that is leading the pack is Tom Emmer. He is actually part of the leadership. He's third for the leadership line. He's the whip, so he has a lot of relationships within this caucus. So it does look like today when they go back in and there's going to be ballots, probably like 2 or 3 it's going to be, because you have to get a majority behind closed doors. And then that individual will be the Republican caucus nominee for Speaker. This will be their 4th one. We had Kevin McCarthy, we had Steve Scalise, we had Jim Jordan, and now it's going to be the 4th nominee. Potentially we'll get that name. We will likely get that name today. The question then becomes, can that individual, though, get to 217 on the House floor? And that's really what has made this process so difficult. Even if an individual has the majority of their conference, if they cannot get to 217 on the House floor, they cannot become Speaker.
Well, we've been here before on a couple of occasions, haven't we, with some of the previous candidates, and, you know, the vote ran away a couple of times from Steve Scalise. But does he have the numbers, and where is he fiscally? We're about to have a conversation with a gentleman from Deutsche Bank. So I think what the markets want to know is, who is this speaker? If it is him, how fiscally tight is he?
Well, that's a great question, because if it's someone like Tom Emmer, he's seen by some as more of a moderate or someone that the Democrats could potentially work with, which is why Punchbowl News this morning is reporting that there's a chance that some Democrats may vote present or may not show up to the vote to make it easier if Tom Emmer does become the nominee, and then there is going to be a House floor vote to help him get and clear that line of getting to 217. The biggest issue that this individual is going to face is, of course, November 17th, we have another threat of a government shutdown. And remember, it was former Speaker Kevin McCarthy who put a continuing resolution on the floor that ended up costing him his job. So are we going to become to another situation like that? We should also note if Tom Emmer, who's the leading candidate right now, but potentially someone like Kevin Hern or Byron Donalds can pull it through. They both left yesterday saying they're going to be making calls. Kevin Hern said he didn't come here to be number 2 or number 3. He wants to be number 1. But then it becomes, for the next point for this process is if they do put a continuing resolution on the floor, will they be ousted? If none of these individuals get it, we can get close to November 17th, which is going to be that pressure point, and potentially there's a vote to then give more powers to the current Speaker pro temp, Patrick McHenry. So it's chaotic, and there's a lot of different avenues that can happen. If anyone tells you they know what's going to happen, I think they're lying.
And Marie, as we look ahead and assuming that we get a speaker elected this week, how do the different outcomes impact resolution of the government shutdown next month? Do we think that Republicans are looking to put the volatility behind them, coalesce around keeping the government open, thinking that it's politically damaging to go through a government shutdown next month? Or should we just expect that this volatility bleeds over into the actual policies as we look ahead as well?
I think you could expect a lot of volatility continuing to emanate from Capitol Hill. That has been a serious place of volatility throughout the entire year. Remember, President Biden had to cut short his foreign trip when he was at the G7. He was supposed to go to Australia so he can get back and deal with the United States on the brink of hitting their debt ceiling and real fiscal calamity. What I would say, though, is that Terry Haynes of Pangea, he has said that the more chaotic this is and the longer this gets drawn out and the closer we get to November 17th, the actually likelihood that we will have a stopgap funding measure go through is easier because the Republicans will recognize, okay, we wasted a ton of time bickering amongst ourselves, trying to get our house together. We have to keep the government open so we can move along and really get down to the business that many in the Republican Party want to see, which is actually passing appropriation bills.
Anne-Marie Herduran, thank you so much, as always, for your insights. I'm sure we'll be here again tomorrow at the same time talking about how there still is no House Speaker. Still with us is Matt Lazzetti of Deutsche Bank. And I've got to say, from an economic perspective, how do you take a look at this? How do you even understand the deficit and what kind of drag that's going to be when we don't know how much that's influencing yields? And frankly, yields at 5%, very different for the U.S. financial profile than 3.5%.
Absolutely, and I think a lot of what we see in terms of the fiscal outlook, in terms of the budget outlook and debt outlook, has been known for a very long time. And I think the market has known that you were going to have this big, perhaps, supply-demand imbalance within the Treasury market for a long time. And the question is always, what kind of catalyzing event do you get that brings it to the forefront for the market? And that's what we've had over the past several months. As we look ahead, what could potentially take some of the steam out of the longer end of the curve? We do have a Treasury refunding announcement next week. To the extent that they show that they are taking into account some of the market moves, I think that would be an important development. From the Fed's perspective, communications that they could have are somewhat limited at the moment. Sure, they could say that they are tweaking QT as they look ahead to respond to these bond market moves, but that seems very unlikely, I think. That is only an environment where they're seeing a lack of market functioning, significant illiquidity. Absent that, I think the Fed is simply willing to lean on, quote-unquote, autopilot for QT at the moment.
Look, everybody is grappling and trying to understand what is it that's driving the sheer magnitude of the volatility in the bond market as we saw last week, and we put on 40 basis points before everything turned around yesterday. There's a wonderful line in the story this morning. The deficit as a share of gross domestic product on an adjusted basis is the widest that it's been and the worst since 1950. I mean, this is the reality, and there is no buyer. There's no permanent buyer, as Lisa and I have discussed this morning in QT, in QE, excuse me. When you read that kind of stat, you really begin to understand the size of fiscal deficits in this country. And if you don't have QE, does this just get a bit worse?
Yeah, I think one of the most striking charts is if you look at the budget deficit versus the unemployment rate. And typically there is this very nice relationship between the two, and that is historically we only run large budget deficits when we have a weak economy. the past 3 years have been historically very anomalous from that perspective. You've had very large budget deficits in the context of an unemployment rate that is incredibly low. I think that's helped to put some steam into the economy this year. We expect that you see 5.2% real GDP growth for Q3. As you look ahead, I think you're right. Some of those price-insensitive buyers that we typically think of, central banks are not there. Banks are likely not there, given what's happening with their portfolios.
These are the stabilizers that Mohamed El-Erian has referred to on a few occasions.
Exactly, and so you rely more on price-sensitive buyers, the household sector, hedge funds, and I think that just leads to greater implied volatility. It leads to larger moves, and it does suggest that higher yields are needed in order to make the market clear.
What happened to the concept that was really held high in economics that more debt led to lower rates?
Yeah, I think more debt can maybe coincide with lower rates for a period of time until it doesn't, and I think that's the environment where we are right now.
How much are you concerned then about a reacceleration of inflation on top of this, right? I mean, that you have this, it hasn't worked, and that potentially you see, based on Coca-Cola passing along 9%.
Backdrop where inflation could very well firm. And it's well-known items. We know health insurance in the CPI is going to pick up. Used car prices, perhaps new vehicle prices, are also going to be picking up over the next several months. It does create this very, I think, uncomfortable environment, particularly for the Fed, if the economy does not slow. Because it may not be that the long end of the curve move is enough.
Who's more uncomfortable, the Fed or the Treasury, given the current state of, there's a wonderful Irish word, it's not crisis, chassis.
So I think the Treasury has issuance needs that they need to meet, and the question is, how do they meet them the best? They may very well decide next week that they can perhaps trim a little bit at the long end of the curve because there's greater term premium there. But for the Fed, it is. I think we were all hopeful that as we got through the summer months, that everything was trending in the right direction. The labor market was moving into better balance. Growth was clearly slowing. Inflation, core PCE inflation was 2.2%, 3-month annualized change.
Yeah.
I think we all got very hopeful that we could get all the way back down to 2%. I think the uncomfortable part for the Fed, and where I think there's greater risk here, is that you can make a lot of progress getting down to 3.5% on inflation, but that perhaps that's where the progress stalls out, and maybe you need a weaker labor market to get all the way.
If you are just joining the program, we are seeing a bit of a lift to markets with the S&P up about 0.6%. Matt, to pick up that point, though, you do have this concern about wages and how they play into this, and we talked to the CFO of General Motors. Are you seeing that as the sign of a peak in terms of labor market power, or as a sign of more to come?
My take is that it's a sign of a peak. I think when you look at the broad macro data that we have in the U.S. economy, you see that people are quitting their jobs at a much lower rate than they were last year, 18 months ago. When you look at wage expectations from small businesses, they've mostly normalized. And so I think the macro backdrop is one in which labor demand has come down, job openings have come down, the unemployment rate has picked up a bit, labor supply has actually picked up a good amount, and that has led to better balance within the labor market. Sure, you definitely still have these pockets that are taking place, particularly in highly unionized areas, where we are going to get wage increases, probably spilling over into price increases. But broadly speaking, I think the labor market is showing evidence of coming into better balance.
It seems like that's been the feeling among a lot of people, although then I get reports saying that there's quits are actually coming down. Did you get some of these messages, and that necessarily, if you look at the WARN notices, I mean, these are the types of data that people are now pointing to for signs of softening, which gives you a sense of how unreliable the major data points really are. Coming up, we do get that major data point at 9:45 a.m. of some of the PMIs in the U.S. Also coming up on the open next hour, Bob Elliott of Unlimited Funds, Andrew Slimman of Morgan Stanley, Mandy Zhu of SIBO Bats, and Colin Sebastian of Baird to parse through whether we can actually say, yes, we are moving to earnings and focusing on that rather than yields. From a beautiful good morning in New York.
Val Ackerman has quietly emerged as one of the key architects of modern sports. As the founding president of the WNBA and now the commissioner of the Big East Conference,
Commissioner Val Ackerman.
Ackerman has a knack for being at the most important tables at the most critical times.
I want to thank Val Ackerman here as well.
Val Ackerman.
I had a big part in this, in how USA Basketball and the NBA could come together to support the women's national team. I feel like we really have proven something. And for me, in my personal role, whether it's in basketball, whether it's helping women, whether it's trying to help college sports hold on to the things that have made it such an important institution, I really do believe deeply in the things that I do and how we can make a difference. And very glad that the Big East has a role to play in the circles that we're part of. I just hope that the momentum we've begun to see continues and builds in the years to come.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
From New York City,
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is a big week because historically, this is the week, the third week of earnings season tends to be where you start to see those earnings expectations start to move higher. If that does not happen this week, I think we're going to be challenged to get that year-end rally going forward.
It's all down to this earnings season. Larry Adam, their Chief Investment Officer at Raymond James. Lisa's absconded. You'll see her very shortly. They've left me in charge. This could get tricky for 15 minutes. Joining me now is Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence. It's a relief to see me rather than the other three, isn't it? Aha. Okay, so we're going to get a few more tech results. Part of the Magnificent Seven are going to get delivered today. Talk to me about Google, owner Alphabet, Google, whatever way round you like to look at it. Are they more immune just simply because I've got to advertise on the platform relative to, let's say, Meta or to Snap? I mean, that's the consensus in the story. Do you believe that?
Yes, and also the divergence in expectations. So Meta is expected to grow 21%, Google 10%. And when you parse through their business segments, you know, the search will likely be resilient. We know they're not losing any share to OpenAI and Bing and YouTube. I mean, that 10% is a low bogey. So you probably should expect some upside there. Cloud, another big segment for them. And I mean,
we really used to get very obsessed, well, not used to get very obsessed, but we are absolutely obsessed what happens in cloud at Amazon, what happens in cloud with Alphabet. How has that grown, and where can that get to, and how important is it?
Yeah, so think of the three hyperscalers, Amazon, Microsoft, and Google. That makes up about $180 billion in cloud revenue, and they were growing at north of 30%. This year, the growth has decelerated to about 18 to 20%. So what everyone is looking for, that acceleration next year, because these are the companies that are buying all the NVIDIA GPUs. And if that doesn't translate into real revenue, then we got a problem. But so far, the story has been that hyperscalers will provide the GPU capacity for generative AI, and that's going to reflect in 2024 numbers.
And those hyperscalers are also critically important to Amazon as well, aren't they? And Amazon's going to be a lovely insight into how strong we are or not on the consumer side as well.
Yeah, so Amazon is the largest player in the public cloud, the $180 billion revenue that I mentioned. It's about 45%. Microsoft is the second big player. And in the case of Amazon, everyone is thinking they are behind in that generative AI race, and the other two are ahead. But clearly, you know, they are the largest player in cloud. And if anything, this generative AI wave is going to accelerate that shift to cloud, because you can only do AI training on the cloud. You can't do it on-prem.
Are you going to be on AI word count in this reporting season in the Magnificent Seven? I mean, it's all you got to do is print those two letters and you're off to the races.
Well, now I think the time has come to guide.
Are we going to be more discerning?
And the 2024 guide is very important. So that's where you are going to see companies that actually guide to that lift from GPU revenue on the cloud. that's where you're going to see, the multiples and the estimates go up. But so far, it's been a huge investment year. Everyone is hoping 2024 is when it translates into revenue.
And then if I talk about Microsoft, Microsoft is interesting for all of the aspects that we've just touched on, a little bit of AI, a great deal of cloud, but also for them, there's the hardware side of this as well. Where does Microsoft fit into the Magnificent Seven?
Well, Microsoft clearly had that early OpenAI partnership, and that helped them, in terms of establishing that generative AI leadership. But I think the PC side is still weak, and you are seeing that decline in that Windows revenue. Clearly, that hasn't changed. Everyone is calling for a PC bottom this quarter, but we don't know if that's going to be the case. And
if we slow down next year, it could be that Microsoft takes the bigger hit, perhaps out of this grouping.
Well, so Microsoft has a lot of application software revenue, and if they don't, add those co-pilots to really complement that, and if there's actually real disruption from generative AI, I would argue Microsoft is at risk. But nobody doubts that Office, will continue to be strong because they added these co-pilots, and that will be a nice add-on to, what you already have from the Office suite.
So Europe is under pressure. Technically, we can argue about recession. China, you can debate whether they're going to make 5% growth or not, but it's tough in China at the moment. With those two global markets very much under pressure, who is perhaps the weakest link in the Magnificent Seven, vicariously exposed to the China story?
I mean, I would say Apple. No doubt about it.
I'm just about to buy a new Apple 15.
From a revenue perspective, 20% revenue, and the supply chain exposure is huge. So if there is a big risk that clearly lies with Apple, the other ones are somewhat insulated because they don't have a lot of revenue exposure. And that's where the internet names like Alphabet and Meta, they have no exposure at all. So clearly, Apple is the one to watch out for in terms of that geo revenue exposure.
Okay, and then of course we have the friendshoring, onshoring. Let's see what the numbers are when they drop. Thank you so much for stopping by. That is Mandeep Singh on all things technology. Let's continue the conversation. We have Matt Luzetti from Deutsche Bank rounding out this 3 hours. I mean, we've sort of covered the globe, but it's interesting when we talk about tech. Don't worry, I'm not going back to your reports as to whether you're using generative AI to deliver them. But what I did want to pick up on is the China conversation. We are so very centric here in the United States and in Europe and the UK. It's amazing when you drop into different geographies how perhaps more myopic we become. Have we spent enough time in the past 3 hours talking about China and the risks?
Yeah, I think certainly it is a big driver of the U.S. global economy. I think it's less so tends to be a driver of the U.S. economy. When we typically think about the beta from China growth to U.S. growth, it's about 0.2, 20%. So if China growth falls by 1%.
So it's an international obsession, not harbored by the States.
I think it's when you look at the U.S. economy, it's 70% consumer.
Yep.
It is very much domestically oriented. And I think particularly in the current environment where services is a big driver of it. That said, we've had several Fed speakers over the past several weeks highlight the global economy as a key risk factor for the U.S. economy. I would lean a little bit more towards the potential lagged effects of monetary policy kicking in, the tightening of bank lending conditions, the tightening of financial conditions as being key drivers for risks out there to the downside. But no doubt, Fed officials are taking notice.
It's staggering, isn't it? Mortgage rates at 8%. Buying your new car is going to cost you an awful lot more this time around. To what extent does the 8% on the mortgage rate really begin to kick in? I mean, there's a stagnation in terms of sales and properties for sales. I understand that. A lot of people are already long their property in this country at 2.5 in the past 10 years. When does it matter that we have mortgage rates at 8%? Is that a very long variable lag? Can that be as injurious as it was in previous cycles?
It's a very long and variable lag at the moment. I think you're right that it has impacted housing activity. We see mortgage purchase applications that are the lowest since 1995. We see existing home sales that are collapsing. But at the same time, the household balance sheet is mostly insulated from this effect, and it is because people have locked in 30-year fixed mortgage rates at 3%. Now, it does have knock-on effects to other parts of the economy. Because of that, people aren't willing to sell their homes. There's a lack of housing supply. You may have job openings in different geographies that people won't move to, and so it leads to this mismatch within the labor market. So there are knock-on effects. There is an impact, But the key channel of transmission onto the household balance sheet just is not as powerful as I think it typically would be.
And in terms of the actual, they'll keep going until they break something. That's a narrative that seems to come through. The Fed are trying to tell us they're going to proceed carefully. Jamie Dimon doesn't care whether it's another 25 bips or not. He's not bothered about that. Is he right not to be bothered? Because at the margin, I mean, I'm not a PhD economist, but at the margin, 25 basis points is not going to make or break, fill or kill this economy, is it?
Agreed. I think if the debate that we are having in several months is just does the Fed go one more time or not, then that's a good outcome for the economy. I think it's a good outcome for soft landing prospects, and it does not have a material impact for the economy. I think it's a good outcome for soft landing prospects, and it does not have a material impact on the economic outlook. Where I think the risks lie, though, are that several months down the road, we do see some uplift in inflation. The economy has not slowed.
That's the biggest risk of all, isn't it? Whether there's a second coming of that brutality of inflation.
That not to the extent that we saw last year,
no.
but some uplift to a level that is uncomfortable for the Fed, particularly if you have a backdrop of strong growth. And then I think the debate for the Fed is not just do they go one time or not. It's a debate about how much further might they have to go. Now, the bond market's doing a lot of work for the Fed right now, so the market is not kind of bringing forward some of these risks. But 3 months down the road, I do think that that's a risk that we could really see.
Okay, Matt, a very full and plentiful plate to choose from. That is Matt Luzetti there, Deutsche Bank. Our guest this morning, rounding out the hour. They've left me alone. Tom and John are on a cruise somewhere. I have it on good authority. There was a red headline earlier on. Lisa Abramovich couldn't take much more, so she left me to give you your final market wrap for this Tuesday. There you go. You have a small bid to equities. Why is it not stronger on the drop in yields? But yields are just drifting along after a brutal day yesterday. Good morning from New York. Up next.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow, with green actually on the screen, with a sense that maybe we've got calm in the bonds that can let stocks to take over. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, stocks looking to snap their longest losing streak of the year. Earnings season ramping up with big tech results from Microsoft and Alphabet. And House Republicans planning another vote to elect a new speaker. We begin with the big issue, whipsawed by bonds.
You know, the first thing I do when I wake up in the morning and to get a barometer on the markets is look at the 10-year.
A lot of this is whipsawed.
We've seen the 10-year move up so rapidly.
Fundamental technical elements have driven yields beyond where they probably should be.
There's so many different forces which are buffeting the bond space.
Challenge in the bond market.
We're finally seeing supply come in and really scare those bond vigilantes.
Geopolitical risk like this, you know, they make investors really uneasy.
Yields are higher. They're probably staying here for longer, but you know, the economy continues to do well.
So far as central banks are concerned,
the bond market is helping the Fed slow the economy.
The rising bond yields that we've seen is doing some of their work for them.
These high levels of uncertainty have unfortunately become a new normal.
We're looking for rate stability.
We're in a time of dislocation in bonds.
What you do is you've got to get through it.
Joining us now to discuss how to get through it is Morgan Stanley's Andrew Sliman and Bob Elliott of Unlimited. Bob, I want to start with you. How much has the whipsawed action in bonds made it incredibly difficult to make any kind of investment, regardless of whether it's in bonds or stocks?
I think a lot of the bond volatility that we're seeing in the short term is driving this sort of day-to-day chop, that idea that the first thing you look at in the morning to understand what's going to go cross-asset, what's happening cross-asset, is you look at the bond market. I think in general, though, if we take a step back, we've had a pretty big adjustment in bond yields, you know, more than 100 basis points over the course of a couple of months. And we're starting to see in that market a bit of stability as yield-sensitive buyers are coming in, starting to cap the rises in yields and able to, you know, give enough demand in the market to help meet that increased supply from the government issuance coming up.
How much, Andrew, are you sort of putting on ice a lot of your bets just to understand where bonds settle in?
Well, yeah, I've been calling for the fourth quarter rally. I thought earnings were going to come in strong, but the speed with which rates have gone up, you know, has gotten me nervous. Now, if you look what happened yesterday, the futures were indicated down. Bond yields peaked and then came down, and that reversed the market. And yet, today, settling in below 5% on the 10-year, you have futures up again. So clearly, as Bob said, it is the bond volatility driving the market. And if we can get the bond market to calm down, I do believe we can get a lift out of other things that affect the stock market, like earnings.
Before we get to earnings, and we're going to get there, Bob, I want to pick up on your point about what's driving some of the increase in yields and the volatility. Peter Scheer of Academy Securities pointing the finger at Washington, writing, quote, "The recent moves in yields have almost nothing to do with the Fed and everything to do with fiscal policy. The 10-year Treasury almost pierced 5% because no one knows what D.C. is going to do, and what we can surmise is not good." Bob, how much does this change your feeling on a broader level, just about bonds as a haven asset, and pushes you toward other asset classes?
Well, I think a lot of the repricing of the increased supply in bonds has mostly happened. And when I look across assets, the biggest question I'm looking at is what other assets are out there are not reflecting the meaningful rise in term premiums that we've seen, the meaningful rise in bond yields. You know, if you think about bonds, particularly on the long end, they've fallen about 50% from peak. And you look across assets, for instance, stocks that remain just off highs. So if I'm thinking about which assets are overvalued in this market, it sure isn't bonds. It's much more stocks, not bonds.
Andrew, want to comment on that?
Yeah, I mean, overvaluation, undervaluation is all predicated on the ability of Wall Street to predict what's going to happen in the future. I think I've been on Wall Street 36 years, and that's the biggest error I see. If you wind the clock back 6 months and said the mega cap tech stocks were overvalued, the reality is their earnings estimates are up for this year, have been revised up by over 20%. So be careful when people talk about overvaluation, undervaluation, because it's the assumption that they've got their earnings outlook correct. And the reality is, for the biggest of the big stocks that drive the S&P, people have been wrong. Analysts have been wrong. They've been too pessimistic. Likewise, when people say the equal-weighted is cheap, well, most stocks, actually, estimates have come down a little bit. So the S&P equal-weighted hasn't looked as cheap because the E has been a little bit too high versus the S&P cap-weighted, it's been too low. So I'm very wary. I'm more interested in what's going on revisions, and that's why tonight's reports are very, very important.
Bobby, you want to respond?
Well, I think the main question is what is priced into the equity markets on the earnings side. And when you look at bottoms up analyst estimates over the course of 24 and 25, the expectations are for a 25% increase in earnings. Now, how is that going to transpire? Even in the best of circumstances, we're looking at 5 or 6% GDP growth. So, and we already have margins that are extremely elevated relative to history in an environment of tight labor markets. And so how do you add up how do you get from a macro perspective down the sort of earnings that are priced into the market just at a time when we've had this additional 100 basis points of long end tightening in the market? Those are the sorts of conditions that typically align with nearer term softening, not nearer term strong earnings growth.
Which is the reason why everyone is looking at earnings, and that really is taking the center stage today. Markets certainly on edge. Ahead of big tech earnings later today, Alphabet and Microsoft reporting after the closing bell. Bloomberg's Katie Greifeld joining us now for more. Katie.
Well, this is today. The biggest earnings week starts today, and it's headlined by big tech, kicking off with Microsoft and Alphabet tonight after the close, as you said. And that starts really 164 companies worth nearly 16 trillion rather in market cap in the coming days. And there's little room for error here, Lisa. These big rallies in these big mega cap tech stocks, they've powered the bulk of the S&P 500, still 10% year-to-date gain. You take out those top 7 names, the S&P 500 is actually lower on the year. And now that run-up has stalled over the past couple weeks, as you can see in that chart. So that really puts tonight's results and the coming days under a microscope. Really, investors are looking for a reason to restart this rally, or at least justify the gains that we've seen year to date. But they're reporting into a pretty punishing environment. It's still early, but Bloomberg intelligence data shows that companies that have missed profits so far this season have underperformed the benchmark by 3.7% the following day. That is the worst showing since at least 2019. So we'll see how the next couple of days goes.
Katie Greifeld, thank you so much. Great work as always. To that exact point, Andrew Slimman, Bob Elliott, you're both with us. Andrew, from your vantage point, does that make you concerned that the stocks, even that beat, are not getting received that well in the equity market?
No, I mean, the setup going into earnings is actually pretty good right now, which is the market's been weak. And so we're focused on something other than earnings. What worries me the most is when the market is red hot going into earnings season and we're talking about the whisper number being higher than expected. So yes, I get the fact that when companies miss, stocks go down, they should go down. That's no surprise to me, but I do like the setup into this earnings season. Stock market's been weak. We're focused on something other than earnings, and that tends to be a pretty good setup.
Bob, what are you looking for to understand whether things are completely mispriced in the equity space and whether earnings can really keep up? Is it also revisions akin to what Andrew was talking about?
Yeah, I think the main question, just going back to that point around the bottoms-up analyst expectations, looking for that 25% earnings growth over the next 2 years, we basically I'm mostly focused on how are companies projecting how they're going to reach those sort of expectations. And I think that's really where the disappointment is likely to set in. On a backward-looking basis, over the quarter, nominal GDP growth has been pretty strong. We're likely to see, decent earnings, not great, but pretty good earnings as a function of that. But really the question is looking ahead and how are these companies going to justify what the elevated expectations are in the market for their earnings growth. And I think that dynamic that you're seeing in the market that Katie Greifeld highlighted is indicative of the fact of how elevated those expectations are and how fragile the equity market is if those earnings come in below what people are expecting.
Bob, is it easier or harder to just focus on big tech away from the other names that are not showing the same kind of strength and have actually had a pretty poor year?
Yeah, well, for most investors, it doesn't really matter whether it's big tech or the little companies. They hold a market cap weighted portfolio, and so you've got to take the S&P 500 as it exists as a combination as the total market cap. And so I think in many ways it's more effective to be trading these markets from a top-down perspective, looking at the market cap weighted basket rather than trying to pick out the particular stocks, because it's really the market cap weighted baskets where you're seeing the huge cross-asset divergences between the significant repricing in the bond market and the lack of repricing in the equity market.
Andrew, from your perspective, are you doing the same thing, trying to compare things on a sort of top-down level? Or do you think, given the dominance of some of these players and some of the narratives, that it's not actually apples to apples in the same kind of way anymore?
Well, yeah, I mean, I think you got to look at actually bottom-up fundamental revisions. And what Bob's talking about of 25% over the next 2 years, that's 12% for next year. And the reason why it looks so juicy is that this year we have had flat year over year, so the comparisons get very easy next year. That's the reason why it looks so good. But what I struggle with a little bit is, well, how can you have 12% earnings growth and the expectation in the bond market that the Fed is going to be cutting rates next year? I don't think those things make sense. So there's a disconnect there. One of those is wrong. Either we're not going to have 12% earnings growth, or the Fed's not going to be cutting next year. And so getting back to your question, it all leads back to what are the companies that are doing the best, where they are exceeding outlooks, they're doing better. I think that's where you get the most likely strength, because those companies can, their PEs can actually go up because the E is understated.
Bob, what do you make of that argument? It's something that a lot of people are saying, that basically you can't have the expectation of rate cuts and the expectation of really good profits. That doesn't match. And actually what we're seeing in the market confirms the strength, because we are pricing out those rate cuts, that the debt sell-off confirms what we're seeing in equities. How do you respond to that kind of idea?
Well, I think a lot of that is on a backward-looking basis. We had a situation, it wasn't that long ago, a couple months ago, where there was an expectation of a significant number of cuts going into 24, and even before that, cuts in 23. That was inconsistent with the strength of the economy. I think the issue here is that the continued strength of the economy actually handcuffs the Fed from being responsive to any weakness that they see in early 24 or even through the middle of 24. And so what that means is the Fed is going to hold the course. Even if we start indications of growth softening, even if we start to see equity markets weakening, the Fed knows that on a trailing looking basis, being data dependent, current policy it roughly makes sense. And so when you look at that imbalance of what's more or less likely to happen, it's much less likely that we get the sort of earnings growth that's priced in than we get the Fed pausing for as long as currently priced.
Bob Elliott, Andrew Sliman, both of you are sticking with us, taking a look right now at the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
Well, Lisa, we are, of course, set here to break a losing streak of 5 days for the S&P 500, the longest since 2022. So let's take a look at what's helping out. RTX, the former Raytheon, surging up 9.1%. They beat profits, $1.25 in earnings. Revenues by 7% for $16.5 billion, and they raised the outlook. Surging demand, analysts very positive here on GE, so some positive industrials that we'll be talking more about the open.
Abby, thank you so much. Coming up, Wall Street weighs in on global headwinds.
We're sitting here with the backdrop, which I think we all acknowledge, of the aftermath of the terrorist attack in Israel and the events that have been unfolding since, and it's desperately sad. So it's hard not to be a little pessimistic given that.
Our team coverage begins next. This is Bloomberg.
Ackerman has quietly emerged as one of the key architects of modern sports. As the founding president of the WNBA and now the commissioner of the Big East Conference,
Commissioner Val Ackerman.
Ackerman has a knack for being at the most important tables at the most critical times.
I want to thank Val Ackerman here as well.
Val Ackerman.
I had a big part in this, in how USA Basketball and the NBA could come together to support the women's national team. I feel like we really have proven something. And for me, in my personal role, whether it's in basketball, whether it's helping women, whether it's trying to help college sports hold on to the things that have made it such an important institution, I really do believe deeply in the things that I do and how we can make a difference. And very glad that the Big East has a role to play in the circles that we're part of. I just hope that the momentum we've begun to see continues and builds in the years to come.
This is Bloomberg.
We're sitting here with the backdrop, which I think we all acknowledge, of the aftermath of the terrorist attack in Israel and the events that have been unfolding since, and it's desperately sad. So it's hard not to be a little pessimistic given that. It's coping with a world where globalization is becoming more fragmented. The risks associated with globalization are getting more connected together. And how do we manage and navigate that?
A big question, Wall Street chiefs weighing in on the escalating macro headwinds. Israel's military saying it anticipates, quote, long weeks of fighting ahead. But a once widely expected ground invasion now being reconsidered. Hamas continues to hold hostages. The Israeli military dropping flyers across Gaza, offering cash and protection for information on their whereabouts. Over 200 people are still believed to be held by Hamas. Let's get to our team coverage right now. Our fabulous team, Bloomberg's Oliver Cook, joining us from Tel Aviv, and Marie Hordern in Washington, D.C. Ali, let's start with you. What's the latest in Tel Aviv?
Yeah, really, Lisa, it's difficult to say where to start because, again, what's going on in the background here, which is something that has not changed but is still going on permanently, which is the constant bombardment of Gaza, which has been sort of uninterrupted for the last 2 weeks, and that's just always going on sort of in the background. But what is also falling today are these flyers that the Israeli, the IDF is dropping, basically asking for information on hostages. It's written in Arabic. It has contact numbers saying basically they'll be offering money in exchange for this information, but also safe passage as much as it can be ensured to those who give more information. And that is just the intensifying effort that we know has been underway for the last 2 weeks to get hostages back. We got 2 other ones overnight from Hamas, 2 elderly women. We understand that their husbands in their 80s are still being held. But again, this is just one of the many dimensions here. And you mentioned the sort of ground invasion. And it sounds like, as we've been discussing throughout these mornings, that the form that this is taking may be evolving and that it may be a more prolonged process with a bit more precision rather rather than the sort of fully anticipated roll in, go door to door kind of ground offensive that many people had anticipated.
And Maria, there's a question around how much the shift in tone from the Israeli government has come as a result of pressure from the United States. The U.S. has been sending more troops over to the region, preparing for withdrawing people from other regions in the Middle East should the conflict escalate. How much pressure is coming from D.C.?
Well, we reported, including myself, along with colleagues last week, that the U.S. and European officials were exerting this pressure on Benjamin Netanyahu and his government to delay this ground invasion, to make sure these secret talks that the Qataris are facilitating to get more hostages out. Now, potentially it's encouraging. We now have 4 hostages, to Oliver's point, that have been released, even though there are hundreds still missing, and at least we know about 10 Americans missing. So there has been that pressure. And I would also note that we've seen a flurry of diplomacy nonstop in and out of Tel Aviv. Today, we had Emmanuel Macron. He was the latest world leader to go to Tel Aviv, to stand shoulder to shoulder, as he said, with Benjamin Netanyahu. And you see a lot of pressure to make sure they can try to get these hostages out. And when President Biden was asked yesterday about a ceasefire, he says, let's see the hostages first, then we can talk.
Anne-Marie, Ali, thank you both so much for giving us the latest lay of the land. Still with us is Andrew Sliman. We've got, of course, also Bob with us as well. And I'm curious, Bob, from your vantage point, how much you're focusing on all of these geopolitical headwinds as a reason to really hide out, Bob Elliott, in the near term in gold and things like that.
Yeah, well, I think most of us have not really experienced a period of heightened geopolitical conflict in our professional careers. And so very few asset managers out there have really navigated these sorts of environments. And I think the thing that you see when you go back through time and study these experiences is the typical 60-40 portfolio is really a type of portfolio that's all in on peace, disinflationary, strong growth. The types of assets that outperform during periods of rising international conflict are commodities and gold. And those are the sorts of assets that are not particularly well held by most investors. And so we're starting to see folks recognize how well gold is performing, particularly relative to bonds in this environment. But given the convexity of gold to this sort of news, it's very easy to see meaningfully greater rises in gold if this sort of conflict starts to heighten even further.
Andrew, your take?
Yeah, I mean, look, the U.S., as it pertains to the world that we traffic in financial assets, the U.S. does not import recessions other than when oil prices have shot very high. So I think as it pertains to the U.S., it's the key is where is crude going to end up? And in the mid-'80s, I think the view by world investors is the U.S. will be the safe haven, and therefore I do think fund flows will flow to U.S. assets as a safety precaution, whether that's dollar, treasuries, or U.S. equities.
What about gold?
I'm not a gold investor. I'm an equity manager. My experience is you sell gold when everyone gets bullish on it, and you buy it when everyone's very bearish on it. It seems like it's getting a lift now. I'd rather be, if I was going to buy a commodity or currency, I'd buy the dollar, not gold.
Just quick final thought, Bob. Do you think that 60-40 then is not going to work in the period that we're heading into?
Well, I think we've basically had, over the last 15 years, the best period of 60-40 that has existed in history. You've had a risk-return profile 60-40 that has been 2 or 3 times better than it's been on average. And so it's time to have investors start to think about what are the other assets that diversify their portfolio. When it comes to rising international conflict, gold and commodities are critical components to protect investors.
And that's certainly what we've seen over the past couple of weeks. Andrew Sliman, Bob Elliott, both of you, thank you so much for spending time with us this morning. Coming up, the morning calls, and later, investors looking to Microsoft and Alphabet to kickstart the rally. That conversation still ahead with Cboe's Mandy Zhu and Colin Sebastian of Baird.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, MoffettNathanson upgrading DraftKings to buy, noting the company's strengthening profit outlook and expense management. Next up, JP Morgan downgrading Foot Locker to underweight, $17 price target, expecting persistent macro headwinds to weigh on their consumers. And finally, Piper Sandler upgrading American Express to neutral, highlighting the stock's attractive valuation after recent declines. Coming up, big tech earnings kicking off with Microsoft and Alphabet after the closing bell. That conversation up next with SIBO's Mandy Zhu and Colin Sebastian of Baird.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, you're getting a bit of a lift across the board, up about 0.5% on the S&P, much more on the Russell 2000. Outside of stocks, that is what is allowing stocks to get a little bit of a lift. Yields quiescent, stasis, not going anywhere that quickly. 4.86% rounded up on the 10-year after a really tumultuous session yesterday. Crude just dipping a touch, and real euro weakness on the heels of weaker than expected PMI data out this morning. Something we're watching today in about 15 minutes is the PMIs over here in the U.S. One stock that we're watching at the open is General Electric, raising its annual profit forecast as rebounding demand for air travel fueled growth in its aerospace business. The CEO saying, quote, "We continue to experience rapid growth driven by robust demand and solid execution. I'm more excited than ever about our path ahead." Sounds like an earnings call. Right now, Bloomberg's Abigail Doolittle joining us with more. Abby.
Indeed, Lisa. GE put up a big beat, but it's not just GE. We're having a day of strength for the industrials overall. Coming into today, the industrial sector about flat on the year. I'm guessing now it's probably higher on the year. Relative to GE, a big beat. They beat earnings by 46%. They beat sales by 6%. And as you mentioned, that strong demand for engines really driving the fact that the company is raising the outlook. CEO Larry Culp, his turnaround plan of multi-year really coming into play here, and he is talking about the aviation operations continuing to experience the rapid growth driven by that robust demand. Now, relative to other industrials, RTX, the former Raytheon, it is having its best day since November of 2020. It is up about 7.4%, also having to do with engines. The loss there was narrower than expected for their engine unit, driving a big beat for the top line, or excuse me, the bottom line. But they also announced a $10 billion buyback, so investors liking that. And 3M rounding out the picture, they also put up a strong quarter as they beat and raised. Some resolution around litigation is seeming to help them. On the year, though, Lisa, it's very interesting because we have 3M bouncing off of an 11-year low. We have RTX surprisingly down 30% on the year after having a big up year last year. But GE up more than 60% on the year. That strength is continuing.
Abby, thanks. From GE to GM, the automaker withdrawing its guidance as a result of the auto strike. I spoke to GM CFO Paul Jacobson earlier today about the decision.
Given that we don't want to speculate where the next plant might be or how long that might be out, we thought the prudent thing to do was to withdraw guidance, despite the fact that the underlying business was actually performing at the top end of our range prior to this. So we'll provide an update with investors as soon as it's over, but we're still focused on making sure that we execute every day.
Katie Greifeld has more. Katie.
Hey, Lisa, yeah, it's unclear what the strikes will mean for GM's full-year profit, but the company did say that so far strike costs have reached about $800 million, and going forward, that'll add about $200 million a week in additional costs as this strike continues. Now, that casts a shadow over an otherwise pretty good quarter for GM. The company beat on both profit and revenue. It managed to grow its market share, but Bloomberg Intelligence points out that the fact that they pulled guidance showed that there's still a wide gap here between the companies and UAW in these negotiations. On the bright side, you take a look at the sell side. They don't seem too fussed. Wells Fargo says that the guidance withdrawal, not too surprising given the strike, and RBC actually expects the stock could climb from here given that the strike impact may already be priced in. But in any case, you look at shares right now, currently off by about 1.4%.
Katie, thank you so much. Sticking with earnings, Coca-Cola boosting its full-year outlook despite raising prices and other macro headwinds facing consumers. The CEO saying, quote, "Our leading portfolio of brands positions us to win in the marketplace today, while laying the groundwork for the long term as well." Joining us now, Bloomberg's Simone Foxman. Simone.
Yeah, Lisa, consumers aren't buying a lot more Coca-Cola products, but they are willing, it seems, to pay more for them. That meaning the company able to boost its full-year outlook for 2023 on a revenue growth terms to 10 to 11%. They had seen 8 to 9%. Analysts had expected it to be a little higher than that range, around 9.9%. The company also saying that profits will grow at 7 to 8%, up from 5 to 6%. But the company does see a little little larger foreign exchange headwind than they had anticipated at 6%. We also saw some beats in the third quarter earnings, with EPS coming in at 74 cents rather than the 69 cents that were estimated. But the real focus is price mix. As I mentioned earlier, like Procter & Gamble, which we heard from in the last couple of weeks, they appear able to pass on these price increases despite some of these concerns about the health of the consumer. We did see some pressure on volumes. Globally, volume was up about 2%, flat in North America, but contrast this to Pepsi, which is also expecting revenue growth of 10%. It is, of course, Coca-Cola's chief rival, but that company has seen volume decline, especially in North America, seeing a decline of about 6%. The earnings call going on right now, CEO James Quincy saying that the European consumer, in fact, is under slightly more pressure than the U.S. consumer. They are trading down more. We will see if that earnings strength continues, but you're watching shares react in a positive fashion to this news from Coca-Cola this morning, Lisa.
Simone Foxman, thank you so much. And finally, shares of Spotify moving higher after earnings, swinging to a quarterly profit after raising prices within its streaming service and posting better than expected user growth across all regions. The company writing, quote, "We're pleased with our Q3 performance and view the business as well positioned to drive continued progress." All of these commentaries of optimism that we keep hearing from the CEOs. Bloomberg's Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. This is an interesting or odd one because when the numbers dropped, Spotify was trading lower for most of the pre-market session. The market's open. We're currently up almost 7.5%. That puts Spotify on track for its biggest jump since the end of January, and a gain of more than 11% would put it on track to trade at its highest level since July. So this is a pretty big response. Strange, though, given the negative response in pre-market when the numbers hit. Top and bottom line beat. A big part of that is the impact of them raising prices earlier in the year. They had a surprise operating profit which came with it. But you look at the subscribers, right? We're still learning that whether it's an audio video related platform, you kind of live or die by your subscriber count. In the quarter, premium subscribers rose 16% to 226 million, slightly above estimates. But then you go to the fourth quarter forecast, and overall active users, both premium subscribers and non-premium, Spotify is forecasting 601 million active users for the fourth quarter, with 235 of those being premium, above expectations. So the impact here of higher prices is working on the bottom line. They're continuing to grow, and also having cut jobs and pulled back some investments and green lights on podcast projects, there is emphasis and evidence that the podcast business is going well, up 8%. And as I said, Spotify on track for its biggest jump since January 31st of this year.
Ed, thank you so much for that. Those are just four of the many earnings movers this morning. We're seeing a whole host of others, including Verizon. And of course, after the bell, Alphabet and Microsoft today, Meta tomorrow, Intel and Amazon on Thursday. More than $15 trillion of market cap are reporting today. Baird's Colin Sebastian writing, quote, "Q3 earnings should generally be in line. We maintain estimates somewhat below consensus for Q4 and 2024, given signs of more fragile consumer spending." Joining us now, Colin Sebastian. Colin, thank you so much. I'm curious just how high the bar is for the likes of Google, like a Microsoft, given how much the shares have run up so far this year.
Yeah, thanks, Lisa, and good morning. So, I mean, we have seen this resurgence of big tech for the year to date that really shows the underlying strength, the structural advantages that platforms like Alphabet have. And quite frankly, what moves the needle for these companies is still fundamentally consumer spending. And with the strong job market, with strong levels of consumer spending, search advertising for Google has been resilient. YouTube has accelerated in growth. And of course, a lot of attention on AI and the cloud platform. And we'll get an update on that here in a few hours.
Well, that's exactly where I wanted to go, Colin. How important is it for them to be monetizing the AI technology at this point versus laying the groundwork for just broader adoption?
Well, there are a lot of services for both individuals and businesses that can take advantage of a lot of this transformation, but it takes time. And so, as you say, there's a lot of laying of the groundwork right now, and that comes with cost as well. So we're keeping a pretty close eye on the expense structure. But at the same time, the cloud transition is still happening. Companies are moving workloads And while there's a little bit of cost optimization happening, we still expect well in excess of 20% growth for Google Cloud Platform.
Who do you think is the most underpriced of the big tech names when it comes to AI adoption?
Well, I think Microsoft obviously is benefiting from a tremendous amount of hype related to its partnership with OpenAI. And ChatGPT obviously opened everyone's eyes to the potential of generative AI. So in that context, Google and Amazon probably have received less of the hype, the benefit of that hype. Amazon in particular has traded off over concerns around AWS and growth in the last month or two. So I'd say perhaps the expectations are a little bit below where we think they should be for Amazon, but Google as well. They are extremely well positioned in AI. They are the AI company, and we think they'll do very well with this transition.
I have to ask this because everyone this morning has been bringing it up. Do bond yields matter to these companies that don't need to borrow? Is this basically the area that is independent to what we're seeing in borrowing costs just simply because they are cash cows?
Yeah, I mean, that is certainly part of the dynamic. These companies have significant cash balances. They're earning more on that cash. But we can't ignore the ripple effect that higher rates have through the economy. Ultimately, Google, for example, is the world's largest media company. So they can't avoid the cycle. They can't avoid whatever happens to their end market, to businesses and consumers. So we'll be very closely paying attention to what they say today about what they're seeing on the macro front with their customers and if there's any pullback in ad spend or activity with consumers.
Colin Sebastian, thank you so much for being with us. Cboe's Mandy Zhu weighing in on upcoming results, saying, quote, investors are focused on the fundamental drivers for stocks, earnings, and higher rates, while looking past macro risks, such as risking rising geopolitical tensions in the Middle East. Mandy joining us now. Mandy, you are the person that I want to talk to. Stocks have been almost havens relative to bonds recently. Can that persist?
That's a great question. And I think what's really interesting to point out is that the way that equity investors have been positioning for higher rates and adjusting to the higher for longer rates regime is really through stock selection and sector rotation, not through macro or index plays. And that's why if you look at the run-up in volatility that we have seen over the past few weeks, it's actually really led by single stocks, not the index. So if you look at the correlation of the stocks in the S&P, that's still remarkably low and is still within the same range that we saw over the summer.
So at this point, as you take a look at earnings, are stocks and implied stock volatility increasing in response to some of the earnings, or really is it just highlighting what a staple it sort of has been as companies look to just general strength and a generally benign backdrop?
Yeah, so I would say if you look at what's been going on for the past 2 weeks, I would attribute most of that to kind of upcoming earnings and pricing in more earnings risk, and actually average single stock volatility is near a year-to-date high, on par with what we saw in March during the SVB crisis. But if you take a step back and look over the past 18 months, what's been even more remarkable is that single stock volatility and the dispersion of stocks that we've seen in the S&P has been really on par with what we saw in 2020. So if you look at the dispersion of stocks in the S&P 500, which you can track by the DSPX index, the average levels over the past 18 months is what we saw in 2020 when the VIX was at 90, right? So that tells you, even though index volatility has declined, we're still continuing to see a lot of rotation, a lot of movement underneath the index surface within these sectors and within the stocks themselves.
What's the main driver, Mandy? Is it really just the macro factors and some of the yield moves, or is this the drivers of the volatility in the specific stocks just directly tied to earnings and the lack of visibility that individual traders have at any given day on what companies are seeing?
To me, I think the primary driver, if you look again at the past 18 months, it has to be higher rates and kind of the incredible sector rotations and the swings in leadership we've seen, right? From growth to value, back to growth. You know, we've seen kind of old economy stocks rally last year, and this year it's all about tech, right? Tech down 40 last year, up 40 this year. So that those incredible swings that you're seeing at the sector and the single stock level, I think that is what is driving the volatility in the market right now is not at the index level. So correlations that actually near historic lows. And historically, what happens is correlation tend to rise when people start pricing in more recession risk. So that's going to be the big question going forward is, are we at the end of the economic cycle? cycle? Could we really start to see things turn? And until it does, when it does, I do expect, index volatility to start dominate on the back of higher correlation. But until then, the way that investors have been really playing for higher weights is through more through more sector and single stocks.
Mandy, I love that we get to speak to you because Tom usually busts my chops when he talks about the VIX, and he says, you can be gloomy and doomy, but look at the VIX, it's doing nothing. Has the VIX essentially broken as an indicator of forward-looking volatility?
So I would argue no, and not just because I work for the SIBO. I think a lot of people have been puzzled by the decline in the VIX over the past year. But if you look across asset classes, the decline in equity volatility is on par and in sync with declines that we've seen across currency markets, across commodity markets, across credit markets. So that tells me, again, what's driving volatility lower across every asset class is the macro picture, right? The fact that we've gone from everyone talking about recession to now the consensus view being soft landing. That is the reason why volatility is low, not because of zero-day option, not because of any equity-specific factors. It's really the fundamental picture of the economy has turned more constructive over the past year.
Mandy Zhu, thank you so much for being with us. We really appreciate it. Meanwhile, some fresh U.S. economic data crossing the terminal. Abby Doolittle has more. Abigail.
Well, Lisa, it is coming in better than expected. We're looking at the S&P global PMIs, both for manufacturing services and overall. The preliminary reading for October, and we're looking at 50. That, of course, is the dividing line between contraction and expansion. So we are slightly in expansion territory. The manufacturing PMI came in just at 50, slightly above. Services, 50.9, also above. Overall, 51 above the survey of 50, so a little bit more in line with some of the data that we're coming out of ISM next week. And these, of course, are smaller to medium-sized businesses relative to the ISM that are larger. But again, the economy, a little bit more in expansionary territory. It'll be interesting to see whether or not this factors into the Fed decision next week, Lisa.
Abby, thank you so much. Coming up, House Republicans trying to nominate a speaker candidate again.
I think the fact that we don't have a Speaker of the House right now is very concerning. I think it's concerning the Republican conference right now.
We'll discuss the state of play in Washington, D.C. That's next. In the meantime, you are seeing dollar strength, euro weakness on the heels of that PMI data. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Company Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I think the fact that we don't have a Speaker of the House right now is very concerning. I think it's concerning the Republican conference right now. I really think that over the next 3 to 4 weeks, there are going to be so many shifting dynamics internationally and potentially domestically that is going to force the hand of the Republicans in the House to really get it together and move forward with a Speaker.
House Republicans currently meeting to select a nominee for Speaker from a pool of now 8 contenders. The previous 2 candidates failed to secure enough support to win the job. Tom Emmer of Minnesota emerging as a possible frontrunner. No candidate is viewed as having a firm hold of the party's majority. Multiple rounds of voting expected today behind closed doors before the floor is scheduled to convene at 11 a.m. Eastern and maybe come to some sort of decision. Joining us now, Kaylee Lyons and Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. What's the latest? What's the likelihood of us actually having a speaker, not only by the end of today, but the end of this week?
I think that maybe is a big maybe, Lisa, when you're talking about the potential that we could see a floor vote today, and that individual that after this closed door meeting, which will see Republicans voting, it might be a couple of ballots till they decide who the majority is, and that person will be the nominee. But when they go to the floor, can that person actually get 217? Maybe the 4th time's a charm. We went through Kevin McCarthy. We went through Steve Scalise. He didn't even get a floor vote. And then we went through Jim Jordan. Potentially, can Tom Emmer become that person? We also should note Byron Donalds left yesterday. He has some support as well within the conference. He said he's going to be up all night making a lot of calls. And then, of course, there's Kevin Hern, who said, I didn't come here to be second or to lose. So there are other individuals that we could see, even though at this moment it does look like Tom Emmer, who's 3rd in the leadership. He's the majority whip. He has a lot of relationships, close relationships with his colleagues. It does look like he's the front runner, but that question remains. Can he get to 217 on the floor?
Kaylee, where are the Democrats in this, considering there was some discussion about possibly working together for some sort of bipartisan solution?
Yeah, Lisa, when we talk about the effort to get to 217, that's assuming everyone shows up for the floor vote, and you require 217 Republicans to actually get the gavel. There is, though, a possibility that because Emmer is a little bit more tolerable to Democrats, theoretically, at least on the margin, because he did vote to certify the results of the 2020 election, that they could help him out by not showing up for the vote, by sitting it out. That is something that was raised by Democratic Congressman Dean Phillips of Minnesota earlier. He just posted on X this morning that the dysfunction in the House is a national and global security issue, going on to say, I would sit out the speaker vote if Tom Emmer will fund our government at negotiated levels, bring Ukraine and Israel aid bills to the floor, and commit to rules changes to make Congress work for the people. So that's one possibility. But of course, if Emmer can't even secure the simple majority behind closed doors to get the gavel, if it still looks like the House Republican Conference is deadlocked, then we could see a revival of the conversations of Democrats working with a handful of Republicans to elevate the powers of Speaker Pro Tem Patrick McHenry, at least for an interim period of time, while the House tries to sort this out, Lisa.
Kaylee, Anne-Marie, both of you, thank you so much. We will be covering this, I'm sure, again with you both again soon. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In markets, after that PMI data from the U.S., you could see euro weakness continuing, dollar strength. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Time now for the Trading Diary. We need to be watching this week. House Republicans meeting this morning as they try again to nominate a speaker candidate. Big tech earnings ramping up with Alphabet and Microsoft after the closing bell. We get Meta results on Wednesday, followed by Amazon on Thursday. And finally, also on Thursday, we get an ECB rate decision and U.S. GDP figures. That ECB rate decision particularly fraught after what we saw earlier this morning with PMIs out of Europe coming in disappointing, the opposite of what the U.S. just reported, with actually PMIs that exceeded expectations. If you take a look at the euro, it is being expressed dipping below 106 at one point. In the equity space, holding on to gains about 0.6%. Half an hour into the open. This was Countdown to the Open. This is Bloomberg.
Ackerman has quietly emerged as one of the key architects of modern sports. As the founding president of the WNBA and now the commissioner of the Big East Conference,
Commissioner Val Ackerman.
Ackerman has a knack for being at the most important tables at the most critical times.
I want to thank Val Ackerman here as well.
Val Ackerman.
I had a big part in this, in how USA Basketball and the NBA could come together to support the women's national team. I feel like we really have proven something. And for me, in my personal role, whether it's in basketball, whether it's helping women, whether it's trying to help college sports hold on to the things that have made it such an important institution, I really do believe deeply in the things that I do and how we can make a difference. And very glad that the Big East has a role to play in the circles that we're part of. I just hope that the momentum we've begun to see continues and builds in the years to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
It's noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Matt Miller, he is out today, but not to worry. Jess Metton sitting in for Matt for the next couple hours, so we're in good hands there. Coming up today, we're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. We had the 10-year hit 5% yesterday. Where are rates going from here? We're also going to check in with Kevin Tynan, Senior Auto Analyst at Bloomberg Intelligence, get the latest on what's happening with our friends out in Detroit. General Motors withdrawing guidance today. We'll get the latest on that and the strike. They are still on strike. And then on the macro view, Eric Weissman, he's the Chief Economist and Portfolio Manager at MFS Investment, Massachusetts Financial Services. They're up in Boston. They're a big mutual fund complex. We'll get their call there. But first, let's kick this hour off with Mr. John Tucker on the Bloomberg Business Flash.
All right, green on the screen after 5 days of declines. Paul and Jess, the S&P 500 climbing this morning, and we're back above the key technical support level. You have 10 of the 11 major industry groups in the index. They're higher right now. Communication services among the leaders. I talk for a living. Getting a boost from Verizon after its earnings. And then you've, of course, Alphabet and Microsoft reporting after the close of regular trading. And with all the focus on bond yields lately, Sam Stovall at CFRA says those earnings certainly solidly back in the driver's seat.
Will we have a fourth consecutive quarter in which we see S&P 500 earnings decline? We're not really seeing an upward move in these earnings forecasts for the third quarter, and I think this will be a very pivotal week for that to take place.
Right now, the S&P 500 up 29 points, a rise of 0.7%, 42.46 on the index. The Dow Jones Industrial Average up 248 points. NASDAQ 100 up 105 points. That's a rise of 0.75%. The 10-year yield right now 1 basis point higher. That is at 486. Overstock.com, which operates as Bed Bath & Beyond ever since it acquired the bankrupt company's intellectual property, says it's changing its corporate name to Beyond. Oh, well, they didn't consult with me. We should say congratulations to our YouTube guru, Elizabeth. She's back from vacation wearing a ring. Congratulations.
Marriage, nice.
Congratulations.
And as I told her in the newsroom, you can always turn to me and Paul for marital advice in the future. Because we know.
All right, John Tucker, thank you so much. We appreciate that. Jess Metton sitting in for Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio here. We got some green on the screen, which is nice to see after a few days of declines. S&P 500 up 0.6%. Let's see where the action is. Alex Semenova joins us. She covers all the markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. What are you looking at today, Alex?
Hey guys, great to be on with you as always. I'm taking a look at crypto stocks today. Shares of companies linked to cryptocurrencies are on the rise, with Bitcoin rallying near the 35,000 level. Names including Coinbase, the crypto trading platform, and MicroStrategy, which holds Bitcoin, are each up well over 10% today. Miners like Marathon Digital Holdings and Riot Platforms are also climbing. And this comes, of course, as Bitcoin, the largest digital asset, strengthens to a level last seen in 2022. This is as optimism grows that the first spot Bitcoin exchange-traded fund could potentially get U.S. approval. Needham analyst John Todaro wrote in a note today that they believe the crypto sector is coming to an inflection point that will lead to more volatility in crypto stocks.
I mean, that's interesting. I mean, if you get a spot ETF and you see the fund flows going into ETFs, I agree. This feels, again, I'll defer to Matt Miller if he were here, the crypto expert. But this really is, to me, it seems like a really pivotal point in the development and the adoption of all things crypto, particularly Bitcoin.
Definitely getting that passive access will certainly draw in more investors, a little less volatile than the stocks and the coins itself.
Yeah, that year-to-date rebound up more than 100% after last year's big rout there.
Yeah, interesting. So again, Bitcoin 34,400. So keep an eye on that. What else are you looking at there, Alex?
I'm also taking a look at shares of DraftKings, up more than 4% last time I looked. That's after MoffettNathanson raised the online sports betting company to a buy rating from neutral previously. It cited its expense management and revenue that continues to top expectations. Analysts there also said that the combination of strong top-line growth while the company reins in expense growth place it on the cusp of a meaningful inflection point in profitability. They said our conviction in the DraftKings story is stronger than ever.
Sports gaming is just massive. And if you happen to listen to sports radio, watch sports on TV, the advertising is everywhere. And it's really competitive. And it seems like it's just going to become, as more and more states adopt it, it's just a heck of a growth story.
Very lucrative industry.
Interesting. All right. And our friends at General Motors, they don't know what they're going to make in earnings coming up?
Yeah, that's another interesting name. Shares were up earlier today, though pairing that gain after they beat analyst expectations for third quarter profits. But the story was, of course, that the company pulled its earnings guidance for the year. They said they're not sure if they'll be able to make up to $14 billion in profits because of the UAW strike, now in its sixth week, making things a little bit murky for its profit outlook.
I just saw, when I was, for all sell-side analysts, like I was for 25 years, October's by far the most important month of the year because that's when Institutional Investor Magazine comes out with their top-ranked analysts.
There we go.
And it is literally every spot higher back in the day was an incremental $1 million in comp. Oof. I'm not kidding. It was crazy. That stupid magazine makes and breaks your
Tell
career.
us how you really feel, Paul.
And so it came out today. You know who the number one strategist was?
Oh, we know. Alex, please tell us.
It's our friend Mike Wilson over at Morgan Stanley, who very interestingly has so far been wrong this year, but was still voted number one again.
He's got that 3,900 price target on the S&P 500.
Yeah. And what's Ed Yardeni at ISI was like number one for the 40th year or something like that, something crazy. So anyway, congratulations to all the analysts out there who got ranked. It's not as important as it used to be, but it was certainly the thing back in the day. Your whole year was geared towards II. From voting ends in
That's what I wanted to know. When does voting?
May or June. And then you tabulate the results. So you mark it from January to June. 80% of your time. You're on the road. You're making phone calls. You're hosting conferences. You're just marketing. Forget the research part.
Well, that makes it even more interesting that Mike Wilson is number one again because his call actually could be starting to play out right now in the second half of the year as the rally kind of stalled out. But until June, he got that first half rally so wrong, as well as a lot of others on Wall Street.
And that's when, back in May was when Savita Subramanian raised her price target to 4,300. Now it's around 4,600, though.
Yeah, so good stuff there. Thanks you very much, Alexandra Semenova. Covers all the markets for Bloomberg. Alexandra, yeah, thank you very much. I think just like Alex. I think that's just cool, nice, short and sweet. Let's go to Ira Jersey. Why? Well, because it's Tuesday and we have to. There's no other reason because Ira Jersey is the rates strategist for Bloomberg Intelligence. He somehow scammed his way over to the UK, ostensibly to see institutional investors. But
is he wearing the suspenders?
No. I think it was just for him to go see some soccer matches. So, Ira, thanks so much for joining us from the London offices, which, by the way, are just the absolute bomb over there for Bloomberg in the city of London. Ira, it seems like your rates market, you had your 10-year Treasury, not mine, your 10-year Treasury hit 5% yesterday. What's going on in your market?
Yeah, it's the same story. It's a repricing of the Federal Reserve and the market trying to figure out how long the Fed's going to stay at this 5.5, 5.75 type Fed funds rate. So we keep bouncing around on the back of expectations of the Federal Reserve remaining hawkish for at least a little while longer. And I think that you're going to continue to see some volatility as the market tries to figure out if that's going to change with some of the incoming data.
What is speculative positioning telling us about the direction of where yields could be heading?
Yeah, you have to be a little bit careful when you look at the futures market positioning, because speculators tend to be fast money, levered investors, CTAs, and those types of investors sometimes pull out of their positions very quickly, but there's someone on the other side of that trade. And that someone right now are asset managers. So when you look at the supply demand for futures right now, you had asset managers that were very long, speculators that were very short. Now that's starting to reverse a little bit, and people are kind of getting out of both of those sides of the positions. But keep in mind, a lot of the speculators who are short are also long treasuries on what's something we call the basis trade.
So, I mean, Bill Ackman was one of those, I think the news crossed yesterday, Ira, that he closed out his short position. Does that mean anything to you guys in that part of the market?
Well, I think people who are short, back at 4%, why not take some profits here, lock that in for now? And usually that's a sign that we're trying to find a new range. It's not unusual for the Treasury market to have really big moves, 75, 80 basis point moves, and then fall into a new range of 30 or 40 basis points. So maybe we're going to wind up in like a 480 to 510 type 10-year yield, which would not surprise me at all, at least until we got some new data or a new inflection point by the Federal Reserve, which could happen next week, but I think it's more likely to happen come December.
Speaking of data, we just also got S&P Services PMI, which actually did surprise to the upside, and it's back above that expansion level, above the 50 level right there. What do you think this means as far as the direction of the economy? I know we're going to have another update on third quarter GDP later this week, but all of this recession debate, when you're looking at this data, Ira, does this really tell you that the economy is headed for a contraction?
Well, it doesn't, and especially when you look at what's happened with this August and September data, it seems like actually some of it's re-accelerating pretty meaningfully. So the chances of a recession, I think, are a bit lower than they were before, and that's one of the things that's really had the market reassessing its outlook for the Fed and therefore for rates in general. Now, that being said, when you look at some of the European PMIs and PMIs more globally, they're much more mixed to maybe a little bit weaker. So maybe the U.S. is decoupling a little bit from the rest of the world, but eventually I think the U.S. will have to kind of follow the more global growth situation.
So, Ira, I know you're over in London meeting with institutional investors. What do they want to hear from you? Where's the interest level for them as they think about the U.S. rates market?
Yeah, well, it's really been, is the sell-off over in treasuries? I'm not 100% convinced that it is, especially when you still have a lot of investors who are relatively long, so there hasn't seemed to be a big capitulation yet. But people are asking about the normal things. It's asking about what's the economy, what's the deficit going to be like, is that one of the things driving the yields higher, what's the Fed going to do, when is QT going to end? So there's still a lot of question marks to, how the Fed policy is going to develop over the next 12 months, and that's going to really affect the market and the market outlook.
What's coming ahead when it comes to Treasury auctions that could potentially fuel more volatility?
Well, Monday we get the Treasury borrowing for the next quarter. And then on Wednesday, we're going to find out how the Treasury is actually going to issue bonds over the next 3 months. Back in August, the Treasury Department surprised us by saying that they had to borrow $1 trillion. And then on top of that, they increased the amount of 10 and 30-year debt that they were going to issue more than we anticipated. I think maybe they'll try and walk some of that back a little bit and grow 10-year, 20-year, and 30-year debt issuance a little bit slower than they had before, but that means that they're going to have to issue more T-bills. So, and T-bill demand has been pretty strong just because there continues to be inflows into money market mutual funds who are the primary buyer of those bills.
So they play soccer over in London, as I recall, Ira. Any opportunity to maybe catch a match?
I did. I went to the Aston Villa-West Ham match. My Villa won 4-1. Ollie Watkins with a left-footed banger, and David Luiz with brace to get the win.
All right, good stuff. Hey, so how's the economy over here? Walking around in London, how's it different from, New York, Ira?
The economy seems to be pretty good. I was up in Birmingham, so not in London, but actually a little bit outside in Britain's second city. And there were a lot of people in the bull ring shopping. There were a lot of bags. People were still spending money here. So it seems like the economy is okay, at least anecdotally.
How about back to office? Does it seem like more people in London are back to office versus the U.S.?
I knew that question was coming from
Bloomberg,
Paul.
there's a lot of people.
Yeah, Bloomberg, there's a lot of people.
Paul's bullish on in office, we know.
Yeah, well, we're back to 4 days a week, so we're getting there. All right, Ira, just lastly, on these markets, is there a scenario where the Fed just says, boy, the market itself is kind of doing all the work for us. We really can stand down here and just kind of look at the data. Is that kind of where we are now?
Yeah, you've had more and more Fed speakers talk about the fact that higher yields in the long end of the curve might mean that they can wait longer before they make another decision as to whether or not they're going to hike rates. So I do think in November they're going to pause, reassess come the December meeting. More than likely they can be done. So I really am big on the Fed doesn't have to worry about high anymore. It's how long do they stay at the peak, and that's the debate that they're going to have. So when we look at the minutes from the November meeting as well as what Powell's going to say next week.
I wanted to ask you quickly, we only have about a minute left, but the spread between the Fed funds target rate and the rate implied by the Taylor rule actually peaked above 10 percentage points in early 2022, but now that spread has actually dropped to its lowest level since early 2021. So is that telling us on some indications how you're doing potentially the math with the Taylor rules? Does that signal that the Fed might actually already be done hiking?
Yeah, maybe a little bit. The problem with the Taylor rule is that it's a model and models can break. We also have another indicator or another tool that policymakers have been using, and that's the balance sheet. So the fact that we have quantitative tightening, that has to at least add a little bit to the tightening of policy above what the Taylor rule would imply. So I think that we're probably a little bit closer after the Federal Reserve announced that it was going to run off its balance sheet, and now we probably are a little bit closer. And that does show, I think, Jess, that we're very close to the Fed ending its policy tightening.
All right, Ira, thank you so much for joining us. Really appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. He's zoomed in from Bloomberg's European headquarters in the city of London, brand spanking new headquarters over there. Just a spectacular building right in the city of London, right around the corner from the Bank of England. So, man, if you're in the money business, that's the place to be in London. S&P 500 getting a little bit of traction here, up 0.7%. NASDAQ up about 0.8%. So we will have more on that. The UAW says 5,000 members at GM Arlington Assembly Plant joined the strike. We'll have more on that coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
You just mentioned that the UAW members' strike is growing in numbers with another 5,000 walking off the job at GM. And the company's latest earning report is out today, but with a big caveat as that strike drags on. Bloomberg's Kriti Gupta reports.
It did come out to be beats. Again, beats across the board, but they did restrict their guidance and they suspended their guidance. So you're not actually getting any numbers for the fourth quarter or any kind of precursor. And they're really attributing that to the volatility surrounding the strikes with the United Auto Workers Union right now. The idea here simply being that as they strike, and I believe in the last 24 hours, Stellantis has dealt with a big strike as well, 7,000 workers walking off the plant.
Thanks, Kriti. Shares of General Motors right now are up more than 0.5%. Novartis raises its profit outlook after the Swiss drug maker spun off its Sandoz generics business. Novartis CEO Vas Narasimhan.
Everyone is seeing coming through in the third quarter is Novartis as a pure play innovative medicines, I think, powerhouse. And you see we were able to deliver double-digit sales growth, over 20% core profit growth, which really shows, I think, the business now really showing what it can deliver as a pure play innovative medicines company.
That was Novartis CEO Vas Narasimhan on Bloomberg Brief. Shares of Novartis are currently down less than 0.5%. Paramount postpones the release of several films, including the latest installment of Mission Impossible, while Hollywood actors remain on strike. The union representing performers resumes negotiations today with film and TV studios. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. Green on the screen, earnings in the driver's seat this morning, while rates have jumped in the back seat for now. Tesla, Alphabet, Amazon, Verizon, they're the leaders in the S&P 500. Verizon shares among the most active, up close to 8% after they delivered their earnings report. And then the economic news of the day, business activity in the U.S. picking up in October. Back-to-back months of stagnation, followed now by a rebound in factory demand and easing in service sector inflation. This is the flash PMIs, the S&P Global Flash Composite Output Index advancing to a 3-month high of 51. Remember, anything above 50, that's the demarcation line. That means expansion. S&P 500 is up 29 points. That's up 0.7%, 42.46 on the index. Dow Jones Industrial Average up 269 points. That's up 0.8%. The NASDAQ 100 up 104 points. 10-year yield right now is pretty much unchanged. I'll call it 4.85 for now. We check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Metton sitting in for Matt Miller. Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube, so you can check us out there. I tell you, this auto strike, Jess, it ain't going away here. It seems like it's getting even worse. The UAW just came across